The market this week wants better data. It wants to be assured that the economy really is strong.
The incoming data has been unstable enough that has kind of reflected itself in the instability of the markets.
This is a normal economy. You're not going to make straight A's every quarter. You're going to have some weakness here and there.
Risk assets have just cruised through this whole thing, and they ignore the volatility.
I think in general, looking at this all very holistically, it's really going the way that the Fed would like it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So is this what bullish looks like? Good morning. Welcome back. This is Bloomberg Surveillance for our audience worldwide. Today, we have Anne-Marie Hordern. We have Danny Berger. John Ferro is still on his tour of a warm and beautiful place. Well-deserved break off. I started by saying, is this what bullish looks like? Because yesterday we had the 30th record high for the S&P 500. And yet you can see it's completely bifurcated, still led by the same stocks. And it raises this question, Danny. Is this as good as it gets? Is this true optimism?
It is a discomfort in this rally. You can see it in the language that analysts are using. So Citi yesterday upgrades their S&P 500 target. This is what Scott Cronert said in it, that traditional macro-determined target setting seems inappropriate. They're no longer using tried and true tests for this. In the past, when we think we've come up with a newfangled way to understand this market, it usually was a bubble.
And what people have felt is, if this is a bubble, I want in. Basically, the fund manager survey from Bank of America, the latest one, comes out. Sentiment most bullish since November 2021. What are they bullish on, Anne-Marie? It's the same thing they've been bullish on all year.
Mag 7, the story hasn't changed. And with cash levels in money market funds, they say at a 3-year low, they're most bullish. As you say, November 2021, cash funds currently have about $6.1 trillion in assets. Their long best trades is the Mag 7. Microsoft, Nvidia now stand at 69%. This is the most crowded trade in history. What I think is a little bit more interesting is the fund survey when it comes to Europe. Curb your enthusiasm, what they say. Remember, there was this window and this thought, maybe it's time that we can get a little bit more exposure to Europe. Well, the political upheaval in Europe has basically shut the door on that, and everyone's starting to stay away. And the only game left in town remains the United States, and it's these Mag 7s that everyone wants to crowd into.
That really speaks to this bigger question, which is, when are we going to start to see a broadening out? When are we going to start to see an actual, true, healthy growth under the surface that leads to another boom in consumer spending, that leads to better consumer confidence? Today, we do get retail sales, Danny, at 8:30 a.m. Eastern, and this comes at a time where a lot of people are looking for some sort of turn in the labor market. Goldman Sachs' Jan Hatzius is coming out and basically saying, we're at a turning point, a pivot point where something could weaken more dramatically. How important is retail sales, the impulse that Americans are sort of born with, the innate impulse to shop?
It's important because maybe it solves this conundrum of that, which I love that we are born with the. I think Paul Donovan has called it hedonism of the American consumer that we're all born with, because the sentiment surveys have been bad. And if the labor market is starting to turn, you think you should start to see that in some of the retail figures. But how much of that, Lisa, will come head to head with all of these companies who have been slashing prices, the Walmarts, the Targets? So does that seep into these pictures? And again, gives us this really confused data point that we have no idea what to do with.
And more companies may have to start slashing prices because they need to keep up to remain that market share. You mentioned Paul Donovan. This morning, he had a great note. He was talking about U.S. retail sales numbers are due. U.S. consumers should continue to spend money they do not have on things they do not need, like me, not Lisa, when it comes to the American consumer. However, anecdotal evidence suggests U.S. consumers are more price sensitive and refuse to spend in the face of price increases. And that is why this retail sales number is actually really important.
Agreed. And very much something people are watching, especially when you take a look under the hood at where we are year to date. Yesterday was another record high, 30th so far this year. Today, unclear, because yesterday we started on a softer note, and through the session we saw that strength. But year to date, the S&P is up almost 15% on the headline number. Equal weighted gain is 4%, right? When you take a look at the Russell 2000, it's down 0.25%, even with the gains so far this year. To me, this just highlights the lack of confidence that people truly have in the innate hedonism of the American consumer.
The irony of all of this is you can do really well in this market if you just buy the market cap weighted index. Also, if you're a fund manager, to the survey's point, it is a stock picker's market if you know the 3 right stocks to pick. So you can do well in this market despite the underlying maybe telling you something more pernicious.
And yesterday, the right stock was Tesla and also Broadcom. Today, we're seeing a little bit of a gain. Maybe this will be 31 in terms of a record high, albeit little gain, basically little change, 55.47. Are we inching toward that 6,000 mark that Julian Emanuel and some others are actually coalescing around for a year-end target? Euro lower just a touch. It's basically been range-bound in this 107.20 point. Really interesting. We're going to get to that in just a minute. The Euro-US divide and how that's shifted over the past couple of weeks. 10-year yields up just marginally after actually a significant sell-off yesterday. More on that later with respect to corporate issuance and how that really affected things. And crude near the highest level going back to April as people start to wonder what this increased bullishness does to demand and also the heat wave that is waving over the United States. Coming up, Citi's Beata Manthey on why she's downgrading European stocks to neutral, to Anne-Marie's point. Lara Rhame of FS Investments and why she expects 10-year treasuries to retest 5% this year. And Bloomberg's Benedikt Kammel on the latest troubles at Boeing. There actually are more. We begin with our top story. Global equities rallying, the S&P 500 posting its 30th record high this year. European stocks are rebounding for political turmoil in France. But Citi's Beata Manthey wrote this: near-term risks for European equities have increased, with markets narrowing and political uncertainty taking center stage. We downgrade continental Europe from overweight to neutral and upgrade the more growth-oriented United States. Beata joins us now. Beata, thank you so much for being with us. We talked extensively about this yesterday when your call came out, and it really raises question. What would it take to see the broadening out that everyone has been hoping for and actually betting on for a good part of this year?
Great to be here, Lisa. Hello, everyone. So we've been bullish Europe since second half of last year, and it's been playing quite well for us. But of course, this narrowing that has started to happen already in May out of the US, there are signs of contagion into narrowing in Europe as well. So it's not narrowing is not necessarily a bear case scenario. It doesn't mean down the market, but the issue is that 50% of S&P comes from growth. In Europe, it's only 15%. So narrowing into growth makes a difference, drives the S&P higher, while not necessarily drives as much high for Eurostoxx 50 or the broader European index. Now, in terms of broadening, and that's really the base case for outperformance of Europe. Europe is more cyclical, so it's a more conducive environment for Europe to outperform when markets broaden. It needs to come from the data, right? Perhaps some more clarification about the political risks in Europe. It will take a few weeks. A bit more of narrowing into the mega cap tech stocks or growth stocks overall, and we'll be looking out into the reporting seasons for signs that this earnings recovery, positive earnings story that has been underpinning the rally up to now in Europe is actually continuing. One caveat, we produce these earnings revision indices that you guys widely comment on and publish on Bloomberg. We've been pointing out that Europe has been the brightest spot there. Analysts have been continuing to upgrade earnings in Europe since March, since pre-reporting season. Now, yesterday we saw the first data point. So last week, it was the first weekly negative revision in 3 months in Europe, pretty broad-based among the sectors. So these political risks you've seen last week evolving have impacted, in a way, analysts' views on the stocks.
Beata, if you look at some of the impact, though, to luxury companies, let's be specific there. LVMH down 7% since the election. Hermes down 4% since the election. Surely some of the babies have been thrown out with the bathwater, and something like luxury won't be impacted by political upheaval.
Absolutely. There is most of the revenues coming for the luxury space coming from abroad. So, of course, we've had the market reaction of selling everything French last week. But a caveat is that we find that actually CAC 40 the French index tends to be more volatile overall into the elections or after elections, local elections, than any other developed market index. So volatility has been granted for French stocks, but of course we've had a very centric risk scenario for the market there. Now on luxury, it's been underperforming for the last month or two, right, after doing very well at the start of the year when markets narrowed. We worry, we've downgraded, we are neutral now. We worry about disappointments from the China story. It's still robust, but less robust than we thought. And of course, the weakness out of the consumer in the US that you've been touching upon.
Following the
it's a fundamental story as well.
But following the summer's political angst that we're all gearing up for Europe, would you potentially consider having more exposure to Europe after that once the dust settles?
Definitely. We'll be watching. So stuff we'll be watching very carefully is, number one, as I've mentioned, earnings revisions, potential continuation of the upside to the EPS for this year. So my targets are quite robust for this year. From the current levels, I have around 4 or 5% upside. So it's not an absolute bear call for Europe. There is still upside, and it's underpinned by the strength of recovery in the fundamentals, but also in the recovery from very low levels. But we see continued positive delta on the GDP numbers out of the Eurozone. So if that continues, I think at one point soon the investors will come back to the idea that they need to diversify and the broadening can pick up. But broadening really has to come from the broadening in EPS. It's been happening, but perhaps the latest earnings revision, negative earnings revision number tells us it could be on hold for the short time being. But over medium term, I think there is still definitely a bull case in Europe.
Beata Manthey of Citigroup, thank you so much for being with us. We really appreciate it. And really interesting call yesterday. This whole idea of a political risk gets kind of raised when it comes to proposals that we've had a hard time nailing down from a number of the different rhetoric that we've heard from both candidates. The latest being from Trump's former national security advisor, Robert O'Brien, who went in an article on Foreign Affairs saying basically he wants Trump, if he gets elected again, to cut off ties entirely with China and to restart nuclear testing. Anne-Marie, can you give us a sense of how realistic people should take this? I mean, when this becomes a kind of political risk that could actually cause some real market disruption?
Well, one thing, it's who it's coming from. Robert O'Brien potentially would go back into a Trump 2.0 administration. His rhetoric on China was probably the furthest we've seen out of the United States. He says as China seeks to undermine American economic and military strength, Washington should return the favor. Washington should, in fact, seek to decouple its economy from China's. Remember, we've been having this debate. What's the difference between decoupling and diversifying? Trump 2.0 looks like they want to ratchet that up and go to full-on decoupling, which, to our guest's point, this is where some of the issues are when you look at some of these luxury names. When China goes for the retaliation, it's in pork, right? It's going to be in these luxury names. And this potentially is going to get a little bit more heated if we get a Trump administration.
And this just goes back to the point of how 2025 is just so confusing, how it's so hard to wrap our head around, because we have heard these proposals from Camp Trump, for example, loss of independence for the Fed, and you quickly get someone who comes out and says, no, that's not really what he's thinking. It's this drip feed of suggestions and rebuttals that, again, adds to a very confused 25 for what the economy will be doing and what policy will be ultimately.
Yeah, well, we'll be talking about this extensively. When we ask people how you're pricing it in, they're saying, we're watching it. Not maybe pricing it in yet, because you really can't, but we're watching it. Right now, let's get to an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hakis. Yahira.
Hi, Lisa. More trouble for Boeing. The plane maker may have installed bad parts in its 737 MAX aircraft, according to a whistleblower. A Boeing quality inspector alleging the company mishandled and lost hundreds of faulty parts for the planes, some of which he fears may have been installed on new planes. This is according to allegations made public by a Senate subcommittee. This coming as Boeing CEO Dave Calhoun is scheduled to testify on Capitol Hill today. The countdown is on for ByteDance to lay out its reasons for suing the U.S. government over the new law requiring it to sell TikTok. ByteDance must file legal briefs by Thursday. One of its main arguments will be that Congress never provided public proof of a national security threat to justify a ban. And Hong Kong will allow trading during typhoons. The decades-long practice of shutting its markets during major storms will end on September 23rd. The closures were seen as increasingly antiquated after the pandemic showed markets could function with most workers stuck at home. Hong Kong gets 5 to 8 typhoons each year. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the data-dependent market.
I think it's less actually what the Fed speakers themselves say. I think it actually will come down to the data. I think if the market sees healthy data, then it will become a little bit more relaxed.
That's next. What is healthy data? You're watching Bloomberg. Good morning. Welcome back. This is Bloomberg Surveillance on a day when we do get retail sales. Sort of a key question mark around this bullish tilt that we've seen to the market. Can it broaden out? Do we see a resilient consumer, or are the cracks more substantial? S&P futures maybe they climb to a 31st record high by the end of today. A lot can happen. It seems, though, like as the closer we get to the end of the day, the more stocks tend to rally. Euro losing a little bit of ground to the dollar, 107.20. 10-year yields just up a touch, but yesterday a pretty significant sell-off. 10-year yields hovering near 430, 429.25, and crude off a little bit today, but yesterday a significant increase and closed at the highest levels going back to April. Under surveillance this morning, the data-dependent market.
I think it's less actually what the Fed speakers themselves say. I think it actually will come down to the data. I think, we have retail sales, we have industrial production. I think if the market sees healthy data, then it will become a little bit more relaxed. It will say, okay, that's fine. The economy is still humming along. Inflation's coming down.
Here's the latest. Investors looking ahead to retail sales and industrial production data this morning, followed by a total of, get this, 6 Fed speakers throughout the day. If you want a list of them, we can give that to you. Barkin Collins, Logan Kugler, Musalem, and Goolsby all coming out. Lara Rhame of FS Investments writing this. My forecast is still for surgical rate cuts starting in Q4, with December the likeliest option. I expect the 10-year Treasury to retest 5% this year. Lara Rhame joins us now. Lara, you've been talking about this for a while, even as a lot of people are saying we're actually seeing the disinflation re-engage again that we saw take a pause over a number of months earlier this year. Why do you think that disinflation isn't going to keep yields where they are, and potentially we could see that 5% level retested in the 10-year?
Because we're actually still seeing quite robust growth. And I think, if we get the impossible dream, which is the Goldilocks scenario of a soft landing, that has to imply the yield curve renormalizing to some degree. It's still so deeply inverted. And, in this world where, the Fed achieves the goal that is so elusive, that renormalization to me includes some surgical rate cuts and a drift higher in long-term yields. The Treasury has been rolling our deficit as ostensibly at 3 to 6 month bill auctions, and they're going to have to push that out. I think, as we get into the election, it's also going to be clear that both candidates have policies that imply larger deficits and, fairly strong growth, but higher inflation. So I'm not at all bullish that this latest round of weaker inflation data is going to be here to stay.
So what are you looking for with respect to retail sales? What's going to get people feeling even more bullish at a time where we're seeing record highs in the overall equity indexes, but under the hood, a very concentrated bet on just big tech?
This is, to me, retail sales can very much be a head fake because it's a nominal number. We know prices came down in the month. And it's also so geared towards goods. And goods is where so much of the disinflation right now is focused. So retail sales may be, sort of this lackluster consensus headline gain of 0.2%. We may even get another small negative. To me, the inflation dynamics really come down to wage dynamics and to rent dynamics, which I think still are going to reaccelerate in the second half of the year. Today, we may actually get the relief that markets are looking for. It's hard for me to think about the data making markets relaxed because the markets seem pretty relaxed. They seem to be just moving higher without concern around higher rates. I think we have to recognize what extreme optimism is built in to the economic outlook that markets see, to the earnings outlook. I like to say that higher for longer earnings allows markets to stay here, even though we're going to get higher for longer rates.
When you look at the consumer, though, do you think that they're refusing now to spend when it comes to price increases? You know, after we got that earnings report, the likes of Walmart last month saying they're trading down, they're trading in.
I do think that the consumer has to rationalize more than we've seen over the last 3 years now. What we have been expecting quarter after quarter is for the consumer to, I think, for consumer consumption growth to move more in line with real income growth. And we are finally seeing that. It means just a slower, more sort of predictable pace of consumption growth. And I think there is absolutely the lowest sort of quarter income quartile of consumer, which is at this point overstretched. We've seen that in the delinquency data. We know the pandemic savings are long gone and long spent. So I think there is going to be sort of at the macro level a paring back of consumption and pockets of consumption that could turn out to be weak. I don't think it's enough to really push us into some kind of economic contraction, but that overall GDP number will look more like 2% this quarter, not 2.5% when inventories are taken out.
So slower growth, still inflation there, just one cut. Lara, I wonder then if this can sustain itself. Leveraged loans in the U.S., defaults were below 6% for the first time last month. For junk bonds, defaults were only 3.6% last month. That data is from Moody's. If what the environment you're describing pans out, can defaults remain so benign?
I think they can. We've seen businesses be as rational as households were. When rates were low, they really refinanced and locked in. They're going to have to, of course, sort of roll up the interest rate complex as they move forward. But 2% growth, my forecast, even though it's slower than what we've been seeing, is still absolutely solid. And I think this is a place where we actually see more room for value creation in that middle market lending space than we have possibly in some of the, large cap mega tech, especially in private equity. So, as we look ahead, I really think that it's important to understand the nuance. Some moderation in growth is absolutely solid enough for that big middle market engine of the economy to perform well and to maintain really solid corporate fundamentals.
When you talk about the head fake of retail sales, I wonder how much lower gas prices factors into this. We saw that in some of the recent inflation data as well, just in terms of gasoline prices having fallen so much. They're now ticking upward. We're seeing gas prices and, frankly, oil prices increase in the face of a potential heat wave. What's the trigger point for that to really change the narrative in a much more significant way?
Well, and this is where I think we forget that a lot of the disinflation, right? A lot of the goods price declines have already happened. Autos were the source, the sort of the original pain point for inflation back in the pandemic, and they've come down really significantly. I think we'll continue to see some, moderation or some deflation coming from that sector. But, right now, that's really already happened. We've gotten the benefit of that. So looking ahead, I think it does turn more to services. Gas prices are such a psychological piece for the consumer. $5 per gallon seems to be a pain point at which the consumer just really feels it in their monthly budget and consumer sentiment drops. We're far away from that now. And unless we get some crazy outlier event like a storm, I think we're going to be okay going into the summer driving season.
Lara Rhame of FS Investments, thank you. There's another reason we're going to be okay in driving season, and it's called the Strategic Election Reserve.
The Strategic Petroleum Reserve, potentially. Amos Hochstein signaling they could tap it. I mean, we're getting close to $4 a a gallon when you look at AAA. That is going to unnerve the White House. Goldman yesterday, they're saying Brent is set to ride modestly. August peak, $86 a barrel.
All I can say is I hear the hum of the air conditioners just sort of like ramping up the symphony in the city.
It's hot in New York.
We're getting ready for.
Rather sit in an AC car than outside at a restaurant this week, I think.
I mean, I think a lot of people would agree. I think a lot of people are going to be at the beach. Some people might be at the movie watching Inside Out 2 if they've never been to a movie theater since the pandemic. Coming up, Stephen Meier of the New York City Retirement Systems. Don't miss this. This is Bloomberg. Can we make it the 31st day of a record close in the U.S. stock market? Welcome back. This is Bloomberg Surveillance. We are seeing a bit of a lift. When I say a bit, it really is an emphasis on bit, less than 0.1% increase. Nonetheless, fully crossed that 5,500 level in the S&P futures. NASDAQ outperforming as it's wants to do because that is how things have gone pretty much all year, up about 0.25%. The Russell 2000 also very much on ground, down by 0.25%. And I want to pause here for 1 second, Danny. To me, this is one of the most interesting divergences. The Russell 2000 can't get a bid and people aren't interested in it right now, even though it is down on the year despite the almost 15% gain on the headline number of the S&P 500.
The problem is there's been so many head fakes this year. We started this year with this huge call that small caps would do well. They had a bit of a rally in December. That proved untrue. With the economy doing well, we said earnings are fine. The overall market can hold up. That proved to be untrue. I think investors have been burned one too many times. And so now how many times have we heard, Lisa, you can't buy small caps until the cuts finally start? That's where we are. And again, you get to this divergence where you could say there are attractive valuations out there, but are you really willing to stick your neck out and buy?
A lot of this has to do with bond market stability or lack thereof. We saw another sell-off yesterday, yields higher in the face of a slew of different corporate bond issues. Today, the sell-off continues, albeit after a really significant rally last week. 10-year yields hovering around that 430 mark, 2-year yields just under 480, 477. And what you could see in the 30-year after that successful auction, just inching away from those levels, 4.42%. When you move that through the currency market, you can see a bit of euro weakness. It really has taken a hit after this divergence last week with the French election, the snap election being called today, 107, 108. Under surveillance this morning. Guess what? There are more problems for Boeing. I know, a shocker. A whistleblower claiming hundreds of faulty parts were mishandled and may have been installed on new 737 MAX planes. The news coming ahead of CEO Dave Calhoun's scheduled testimony before a Senate panel later today. It seems like the news, Anne-Marie, just keeps getting worse and worse. What more do we have to unleash, and how do we sort of view this in the larger question of saving a company that this country really relies on?
Right. It's too big to fail, too important to fail, really, actually, when it comes to Boeing and what it means for the defense industrial base, not just what it means for getting on planes as consumers. He's going to be at a hearing today, Dave Calhoun. He's going to talk about some of these shortfalls and acknowledge them. But he is going to get an absolute grilling, especially after this whistleblower's report coming out when he's on Capitol Hill. Also, Bloomberg reporting that the hunt for a successor is really starting to ramp up. So potentially he'll get some questions on that, and maybe we'll get some color.
And Wall Street Journal also had a story that no one wants to take the job. That Larry Culp from GE was one of the big candidates that people would thought. And again, according to the Journal, he doesn't want the job. Insiders at Boeing, apparently there's a lot of complications for them to take the top job. So Calhoun needs to lay out this vision of here's what we're going to do. Here's how we're going to fix this. But he can't even tell them who's going to be taking the reins. That is a complicated position to try to figure out.
Which is maybe the reason why nobody wants to take the job. In another question of who's going to take the job, Donald Trump's former national security advisor, Robert O'Brien, is calling for him to cut off all economic ties with China, as well as resume live nuclear weapons testing if he wins a second term. In an article set to appear in Foreign Affairs, O'Brien is saying, quote, as China seeks to undermine American economic and military strength, Washington should return the favor. Anne-Marie, aside from what this would do, et cetera, sort of extrapolating this out, I want to understand the significance of this individual, the role he has played in a former Trump administration, and the feasibility that some of these proposals could really see the light of day.
Well, he was his last national security advisor. He recently said he's in regular contact with the former president. What's interesting is that in our reporting, we know that potentially he showed Trump this article that's going to appear in the Foreign Affairs magazine. Potentially he did, but the campaign is coming out and saying these are not actual specific policies of the Trump campaign until it comes out of the president's mouth. So there's a little bit of tension, I think, there you can see. But clearly, if he's in regular contact with the former president and he led his national security team on the last administration, you have to give some credence to what he's saying. And he's talking about a complete decoupling when it comes to the United States and China.
I know we're probably not going to get this, but how nice would it be to actually hear whether these policies are in Trump's mind during the debate? How nice would that be to hear him actually express some of these? And that's continually part of the fear that a lot of it is theater and we're not actually getting concrete, here's what my platform is from Trump, which again goes back to 2025 being very unknown.
We're hearing plenty of internal thoughts from Federal Reserve officials. We've got a heavy dose of Fed speak on the way today. 6 Fed officials are going to be having speeches. Plus, we get retail sales and industrial production. It all comes after Philly Fed President Patrick Harker said that one rate cut is appropriate based on his current economic forecasts. Interesting, given the fact that he had sort of a dovish tilt in prior utterances. Joining us now, I'm so pleased to say, is Stephen Meier, Chief Investment Officer for the New York City Retirement Systems. Stephen, it's wonderful to speak with you as someone who has to be sort of an adjudicator of the national policies of how we invest for public servants. How do you understand the confidence, the bullishness in a market that is really hinging on such narrow leadership?
Well, I think if you look at the markets right now, you're right, there's no breadth, and clearly there are some real concentration risks. People talk about American exceptionalism. I think it's the artificial intelligence halo effect that we saw last year spilling over to this year. So we look at it from a standpoint of it's really mega cap exceptionalism. What we do, though, we're long-term investors. We manage diversified portfolios that are resilient and made to perform in different types of environments. So we're more strategic than tactical. We're not actually trading. Having said that, we have recently done strategic asset allocations across the 5 plans. We are reducing our exposure at the margin to U.S. equities, large cap in particular. We're flat to maybe down a little less in non-U.S. equities to fund increased investments in private assets.
Within those private assets, because I know you made an announcement to start this year that you would start increasing your allocations. How are you thinking about real estate within that? Because there's still trouble. MSCI said $38 billion worth of office buildings were still in distress. Surely it's only going to be worse with stubborn rates and loans coming due. Have you pulled back your exposure on real estate specifically?
Not necessarily, Danny. We have obviously a diversified portfolio. We're in non-core and core real estate investments. If you look at our investment portfolio right now, it's about 31% multifamily in real estate, probably about 36% in industrial logistics. So we're diversified away. We have an underweight, intentional underweight in retail and office space in particular. I think it's another 2 years in terms of those situations working out at least.
Another 2 years. So how do you want to be positioned for 2 years? I mean, do you pull out completely when that comes due? That is a scary prospect. Because again, what we've seen is this rolling default. It's not this one big event. It's this continued issue. So what does that look like in 2 years?
Yeah, for us, it's more around putting money to work, putting new money into the sector. So obviously, we're not forced sellers. We don't need to be a seller. We're long-term investors, again, with a much longer-term horizon. So we're not panicking, but we're also not stepping in at this point. I know there's some smart people out there that think, well, where valuations are and prices are, it's probably close to a bottom. I'm a little suspicious. I think that has a little more to go.
Elsewhere, you know, if it is higher for longer, if it is we're not going back to a zero rate environment, are there other investments that you've had to rethink, things that just frankly won't work in this environment going forward?
Well, I'd say we focus more on fixed income as a core holding in the portfolio. So if you look at the yields you're able to get both in private and public fixed income now, it's obviously more compelling than it was in a zero interest rate environment. I also think the zero interest rate environment was very negative for the markets. I think it actually leads to suboptimal investment decision, over leverage. Another concern I have, just where we are right now, we've got leverage around the world at 225 to 250% of global GDP. I think that's going to be more of a challenge, I think, domestically and abroad.
How concerned are you about the deficit then, given your last point? Are you in the Steve Eisman's camp of, as Lisa would say, oi, the deficit?
Yeah, I am concerned about the deficit. If you just look at the trajectory of the deficits that we're racking up, we've got, about 98% of outstanding U.S. Treasuries relative to GDP, expected to go up to about 116% of GDP in the next 10 years. Those are dangerous levels. And just the amount of paper we need to roll consistently through this auction process. I know, Lisa, you follow the auctions. We had a couple good auctions this past month.
We did.
10s and 30s went okay, 3s not so well. better than 2s, 5s, and 7s last month. I think it's worth watching because I think there's a lot of information coming out of those auctions. And I do think the size of the auctions are going to be a headwind for the markets. It's a risk factor for investors.
Can you give us some perspective? You said you just shifted your asset allocation to focus more on private assets. Was that away from equities? Was that away from bonds? Was it away from both? I mean, how does it sort of break down now versus, say, 2 years ago?
Yeah, so we're operating under somewhat of a constrained opportunity set. So we had a limit up to only 25% in private assets. That's now been increased to legislation to 35%. So we were a little overweight in global equities. We pulled those positions back a little bit, mostly from U.S. large cap in particular. But we still see a lot of opportunities out in the private asset sector. We think that's a growing area of interest. A lot of people have pulled back because they've been overdone. We've seen opportunities in secondary sales. So we're actually, continue to put money to work, I think, very proactively in those spots. We like private credit. We think the private credit is actually compelling in terms of, obviously absolute returns in terms of base levels higher. Most of those obligations are floating. We've got SOFR, 3-month SOFR, 534. So we have a 7% actuarially assumed rate of return or benchmark. And I'm proud to say so far, fiscal year to date, we're ahead of that. We got another eight or nine trading days, so we'll see where we wind up.
There has been this widespread criticism of private credit that they've been in this extend and pretend mode, that they've just been waiting for rate cuts. And until that happens, they've been very lenient to those that they've been lending to. But at some point, the music stops. Do you share that concern? And how careful have you been picking managers if you do?
Great question, Danny. So I think you have to be really careful. There's a lot of new entrants into the private credit markets. We tend to focus on the Ares, the Apollos, the Oak Hill Advisors of the world. We do most of those investments through separately managed accounts versus GPs or as a limited partner. We still see good opportunity there, but you really would need to pick your managers. We also like more opportunistic funds that can toggle between public and private where they think the valuations are cheaper.
Well, that gets to this other part of the industry that the small players can't survive anymore, that in private assets, it's just the big getting bigger. As an asset allocator yourself, is that what you expect? Do you expect that the smaller players are not going to have that demand and some sort of consolidation needs to happen in this industry?
I don't know. I think, obviously because of our size, we have the privilege of managing about $280 billion in assets. We tend to gravitate to the larger managers. I think the difference for us this year is there's been a lot of pullback on the part of other public pension plans and institutional investors. So we're able to get better access to the better managers and negotiate much better fees, co-investments, in terms of averaging down the cost of those transactions.
So just to say, today we're talking about retail sales, we're talking about Fed speak. Do you watch any of that? Do you care? Or is it sort of, noise as you focus on ways to uncorrelate yourself from it all?
Lisa, I shouldn't watch that, but of course I watch that. and I'll tell you why. Obviously, our underlying beneficiaries and participants watch that. We get questions all the time. My trustees call me all the time and say, what's going on in the market? People are concerned. How do you feel about things? So we watch it. We watch it also as a matter of managing and monitoring the performance of the funds. Are they managing to expectation? But yeah, we focus on all that. We're in the markets, but as I said earlier, we're not tactical, we're more strategic, we're long-term, but we do care what happens in the short term as well.
Stephen Meier, wonderful to see you. Thank you so much for being with us. Really great to hear what you have to say. Stephen Meier of the New York City Retirement Systems. We appreciate that. Right now, let's take a look at what's going on elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackis. Yahira.
Hi, Lisa. U.S. envoy Amos Hochstein is in the Middle East looking to ease tensions between Israel and Hezbollah. Fighting has continued across the border with Lebanon as Israel continues its campaign in Gaza. After meeting with Israeli Prime Minister Benjamin Netanyahu, Hochstein is expected to meet with opposition leaders. The news comes after Netanyahu dissolved the country's war cabinet following the resignation of Benny Gantz. China-based smartphone company Huawei has surpassed Apple's iPhone in sales in the world's largest smartphone market, and it's setting its sights on new sources of revenue. Huawei is looking into taking a cut of in-app purchases on its App Store, following in the footsteps of the longtime practice used by the likes of Apple and Alphabet. The company has been discussing a fee of about 20% with developers, lower than the 30% fee imposed by the U.S. tech giants. And France got their Euro 2024 campaign off to a strong start, beating Austria 1-0, but it may have come at a significant cost. Star striker Kylian Mbappe suffered a broken nose in the match, leaving him in doubt for the rest of the campaign. The French football team said a protective mask will be made for their captain, but his status for the rest of the tournament remains unclear. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. What kind of protective mask? Is it going to be full Hannibal Lecter?
Well, he went on Twitter and he said, any ideas for a mask with like those mask emojis? I don't know. It's going to be interesting, but I guess he wants to continue playing. It's a big deal. It's the Euros.
Bad for the guy. He got a yellow card essentially because he had a bloody nose and was on the pitch. I feel bad for him. You can't
he was
help
sitting down, wasting time.
The ref wouldn't let him put in a sub. We could talk about this all day, unfortunately.
Yeah. Maybe we will. Right now, up next, allegations of misconduct, yet anew, at Boeing.
The minute you start to hide something in a big company, others notice. Stay tuned to the fleet, know what it's doing every day, all day, and then be transparent about everything you see.
That's coming up next. This is Bloomberg. We are still talking about Mbappe's potential mask, and we're getting plenty of commentary. Keep it coming. Right now, we're looking at markets that are trying to rally for another day, potentially 31st record high if we maintain some of the positive momentum by the end of today. We can see a bit of euro weakness. Yields up just marginally, but we've really retraced a significant swath of the rally that we saw last week. Under surveillance this morning, new allegations of misconduct at Boeing.
I believe transparency of all things and relative to all cultures is about the most powerful word I've ever seen. Any company, especially large-scale companies who are willing to be transparent about everything, they'll suffer less. Because the minute you start to hide something in a big company, others notice. Stay tuned to the fleet, know what it's doing every day, all day, and then be transparent about everything you see.
It sounds good. Here is the latest. Fresh allegations against Boeing with a whistleblower claiming hundreds of faulty parts were mishandled and may have been installed on new 737 MAX planes. It's yet another hurdle for outgoing CEO Dave Calhoun as he prepares to testify before a Senate panel later today. Joining us now is Bloomberg's Benedikt Kammel. Benedikt, I want to start with the commentary that we heard from Dave Calhoun himself about the importance of transparency, about not hiding anything. Why is it, given that ethic, that week after week there are new disclosures that we hear coming out about this company?
Well, it's probably because of the unique situation that Boeing is in and has been in since that January 5th accident that we've written so much about. And it's sort of, the more you dig and the more you are under the microscope, the more people will find out. And this is precisely what's happening. We've had a whole slew of whistleblowers come forth. The latest one you just referenced, saying that they mishandled parts, that they were sloppy at their factories. And this is only the latest one, as I said, of several of these allegations. And the timing, obviously, is very awkward. We have Dave Calhoun, the Boeing CEO, appearing in Congress today. A Senate panel will grill him, so he'll have to answer to that. So obviously, the narrative is sort of stacked against him and the company.
What does he say on a day like today in front of all these lawmakers, which, for all intents and purposes, are going to absolutely skewer him?
Yeah, you're absolutely right. And this is really about performance more than really revelation. I don't really think we're going to find out anything dramatically new. I imagine he's done some very deep coaching about sort of the tone, how he comes across, the right level of contrition, but also some level of defiance. You know, he has the company behind him that he has to protect, and something of a path forward that he can offer and say, look, we're obviously going through a very tough patch here, but this is fixable. Now, whoever fixes this will probably be somebody who follows Calhoun. He did say a couple of months ago that he would step down eventually sometime later this year. But, you know, for all intents and purposes, this will be a very difficult moment for him. One smart observer said there's no winning for Boeing today. It's only really the degree of how they lose today. And, you know, for him, it's really how much of a line can you hold? How much can he offer?
The senator who chairs this panel, Richard Blumenthal from Connecticut, a Democrat, he says Boeing needs to stop thinking about the next earnings call and start thinking about the next generation. Do you think that their rhetoric, this performance, is about the earnings call? Are they actually trying to solve the underlying problems, which, to Lisa's point, we see week after week in all these whistleblower reports?
I mean, it's a nice soundbite from Blumenthal, and that is sort of goes to the heart of the allegations against the company that they've put profit over performance in terms of the engineering side of things, that they've been too slick in making the numbers work, stock buybacks, dividends, executive compensation. All of those things obviously don't look great when the underlying product, the aircraft, is having severe problems. Now, this is something that I said the successor will have to fix eventually, sort of think about the culture shift that Boeing needs to go through. And Calhoun has spoken to this to some degree. You had that soundbite a little earlier where he said transparency is key. But also sort of turning around the ethos of the factory, making sure that people put engineering before finances. So all of these things will be on the table today.
And so much rests, to your point, Benny, on who takes the job next. Yet Wall Street Journal has a story that nobody wants this job. Where does the CEO search stand?
Well, it's probably a little bit too harsh to say nobody wants this job. If you take the flip side of that, you could say this is arguably the most important and potentially sort of lucrative job, not financially, but in terms of the outcome in corporate America. If you can fix Boeing, you know, you're made as an executive. And the good news is there's also kind of a flaw in this because the company's not going to go bankrupt. You know, they're not going to go out of business. So there will always be Boeing. So if you can turn this around and make it a multi-year sort of re-engineering effort, then that is a great feat. Who's who's on the list? There's a number of people that we've spoken about. Larry Culp from GE is one of those people. Pat Shanahan, who runs Spirit. There's a number of others, but the search continues. There's no obvious candidate that has emerged at this point, also no obvious internal candidate. There's the Farnborough Air Show coming up later next month. Maybe around that time is when we might see some white smoke. For the time being, as you said, the search continues and there's no obvious candidate.
Benedikt, for a hot second, people were suggesting that maybe the issues at Boeing would lead to lower deliveries to a lot of airlines globally, and this would actually lead to lower capacity and then increased costs. Somehow that has not transpired so far. Are people still talking about that, or is that sort of something that has faded in tandem with a cooling in some of the demand that we've seen globally?
It really hasn't faded. I mean, you might see it less pronounced in some markets, but overall, this ripple effect that we've seen since the Boeing crisis erupted is still very much intact. Boeing can't deliver the planes in the numbers that they had hoped to. They're capped by the FAA. Airbus is delivering more planes, but also can't put out as many as they'd like to. They both have supply chain issues. And all these things are leading to a situation where the airlines are asking, where are my planes? The demand is there. The people want to fly, both corporate and leisure travel, but we're just not getting the new planes. We have to fly our older planes longer. The repairs are sort of crawling up. So this has created a real bottleneck in the industry, and it's still there.
Bloomberg's Benedikt Kammel, thank you so much for being with us. Danny, you raise a great point, which is who wants this job? And there might be people who maybe think that they can make a name for rescuing this company, but it seems like a pretty high bar to kind of hurdle. We don't even understand the scope of the problems.
And then there's also the flip side of this is who would shareholders be happy with as the CEO? Larry Culp was one of the names Benny mentioned that Wall Street Journal said wasn't interested, but would you want an outsider of his ilk? I mean, Boeing is a difficult beast to wrap your hands around. Maybe you don't want an outsider rather, but an insider, someone who's been complicit, let's say, to all the problems, it's a lose-lose.
Yeah, it strikes me, Emery, we're talking about this company that essentially is a product of national planning. This is a company that was anointed a national champion by the United States. Is there any discussion, and I'm asking this seriously, among political analysts saying, what is the benefit or detraction to have national planning at a time where there's increasing impetus to invest in infrastructure and all sorts of industrial behemoths of yore?
Well, they definitely want Boeing. They need this to be done and dusted and to move on. The FAA needs Boeing to be that national championship that they want it to be. But to the point of the CEO search, what I thought was interesting, Benedikt said this could potentially be a great challenge for an up-and-coming executive. But also he said something about you can't really fail in the sense that the government will not let that person fail if this is a too big, too important company for the U.S. to fail. So in that sense, potentially, It is an interesting job because you almost have a safety net that this has to work. There's no other option.
So are you pitching this? You're basically saying, listen, if you come, we all have your back. We don't all have your back because it's got to succeed. We have to have safe planes, bottom line. I mean, the point being that at the end of the day, we can't have whistleblower after whistleblower suit saying, faulty parts, et cetera. We could talk about this all day. We may do that. But we are going to also be talking about what we're seeing with the rally in markets. Coming up next, Peter Tchir of Academy Securities, Bloomberg's Will Kennedy on the crude market, Marci McGregor of Bank of America on that Bank of America fund manager survey going full bull, and Sucharita Kodali of Forrester Research. This is Bloomberg.
The narrative has been shifting towards the economy slowing more than what was anticipated.
Part of the reason the data is cooling is because the fiscal impulse is starting to fade.
How long will the Fed maintain higher for longer, and does that increase the risk of recession?
There are a lot of ways that we could get to 2 cuts this year, and that would be probably September and December.
What the market is probably most worried about is a scenario where the data weakens, the Fed is slow to react. That is often the worst outcome for markets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Counting down to retail sales amid potentially a 31st record high if we keep up these gains. Welcome back. This is Bloomberg Surveillance. Good morning. Jonathan Ferro is off today. Anne-Marie still here, although, who knows? She might go down to southern France. Danny Berger, thank you for being with us this week and next. We definitely are talking a lot about the narrowness of this rally. And it's sort of interesting, honestly, the first hour, Danny, talking about both this complacency that a lot of people say in markets at the same time that others are saying it feels shaky. So which is it?
It's weird because it's both. It is complacent and it is shaky because all you need to do is buy a couple of stocks and you can do well. I think one of the funnier things I saw yesterday, we're really enthusiastic about AI solving all of our problems and companies doing well. So McDonald's had partnered with IBM to do automated drive-thrus, AI drive-thrus, and they canceled their partnership yesterday because people were reporting things like they're getting hundreds of chicken nuggets being ordered for them. They were getting bacon on top of their McFlurries. I mean, here's a great example of us saying, AI is going to solve everything for so many companies, and they literally have no idea what they're doing.
It reminds me of Sleeper, the Woody Allen movie, where there was a tailor and it comes out and everything is 5 times too big. It raises the question, though, that as people get lost in the AI euphoria, there is this question of political risk that I see increasing in all of the notes. That last week, was really kind of a gut change for a lot of people, given what happened in France and how much that shifted allocations across the board away from Europe back into a select few U.S. AI companies.
Well, we heard from Citigroup today about how they're now underweight or neutral. They wanted to be more exposed to Europe, but they're still concerned about this political risk. Maybe that changes after the election. But then, of course, there's that other geopolitical risk of what happens for this tit for tat for China. When it comes to these continuously record highs we see and comes to the fund manager survey, again, it's the 7 same names. If you're not in them, you're not exposed to it. Microsoft, NVIDIA now stand, and the others of the Mag 7 now stand at 69% in terms of the long bets, the most single crowded trades we've seen in history.
Which raises the question of what actually retail sales could change, if anything. We were speaking with Lara, Rhame, who said that this is going to be a head fake, Danny, that essentially you might get some softening in retail sales, but this is just a sort of temporary blip, and it's going to see a resurgence once again later in this year. How do we act in a data-dependent way when people say the data is noisy and one data point does not make a trend?
Right, because also the data point, trend or no trend, it doesn't make a difference to this market. It does feel that way, that regardless of what we get today, that the Mag 7, the big cap tech stocks, aren't going to care. But the data is confusing, and it's do we have the appropriate measures for this world, especially with retail sales, where the richest among us can keep spending and the lower among us cannot. Does the data accurately reflect that? How do we really interpret something for data that was built when it was more of a monolith of the consumer?
When you bleed this through the market, it's up. And that's what you see today. After yesterday, it closed at the 30th record high of 2024. Today, we're basically unchanged in the S&P, taking back some of the earlier gains. But you can see gains continue in the winners of the bunch, which is the NASDAQ 100. Euro a little bit weaker, 107.14. 10-year yields, and this was interesting, basically flat on the the day, 4.28%. Yesterday, we saw a real sell-off on the heels of corporate bond issuance. I find that interesting, given it does seem like on the margins, people are looking for how to shift their money in the fixed income space. And crude off just a touch, but yesterday closing at the highest levels going back to April. Coming up this hour, Academy's Peter Tchir as the S&P 500 notches an all-time high. Bloomberg's Will Kennedy as oil hits the highest level since mid-May. And Bank of America's Marci and McGregor following a bullish fund manager survey. We begin with our top story, big tech driving the S&P 500 to its 30th record of the year. Peter Tchir of Academy Securities writing this. AI seems the big story yet again. It would be nice to see the underperformers catch up or take leadership, but it seems like the narrow leadership continues. Peter joins us now, and I agree with you. It would be nice to see some sort of, participation, collectivity to this rally. Does it make you bearish on it or just sort of wistful?
More confused, I think. Last October, November, it was easy, right? It felt like we're coming down on inflation. There are all sorts of reasons for the laggards to catch up, and yet everyone was just investing in a few names, and that worked out very well. You picked the laggards, and you did really well in there. Commercial real estate did well, regional banks, Russell 2000 outperformed well. And right now, I just don't see that. There's just no, we have a good story here. The economy seems to be doing well. The data, while mixed, still seems to be showing strong enough, and yet we can't catch a bid to anything else. And I think the one thing you pointed out, money is flowing into the U.S., but it doesn't even have to go into 7 stocks, right? If you just put it into an index fund, right? If you put it into the NASDAQ 100, about 40% of that money gets allocated to 8 or 9 stocks. So I think most of the money is not coming into directly to those stocks. I think a lot is coming into indices or ETFs or even to some degree mutual funds. I think that's very unpopular. But to the extent it's getting invested in those, it all gets funneled into these same 7 or 8 stocks. So I think that's what passive is doing to us right now. It's forcing all this money into these relatively narrow things that have a good story. And on the factor side, you have momentum. Momentum's been working phenomenally well. It's probably been the one trade that's consistently worked. And unfortunately, or for better or for worse, those same stocks form momentum. So everything's piling into that no matter how you look at it.
Well, and I hate to use the B word, but when does this become a bubble or a problem or something that becomes a note of fragility rather than just something logical based on how much money they're making?
For me, I've been questioning the valuation. We've been bearish from time to time, not, pounding the table like this is overvalued or bubblish or anything. But I'd say last week I started getting comments, even from people who own these stocks, who have been big believers. They're looking at some numbers and saying, I have no idea why this is up this much. And so I think that's something to watch. More and more people do, I think, are trying to figure out what's going on with the options market, because that's the other part of this. I think it's daily options, weekly options, whether it's on the ETFs, these weekly single stocks. That, I think, is driving a lot of the activity. That's why you're getting these 10%, 14, 15% moves. You get stops out.
And that's something that I think has been really overlooked with NVIDIA. In their stock split, not only did it make it easier for everyday investors just to buy the cash stock itself, but all of a sudden it's so much easier to trade options on NVIDIA too. It is cheaper to do so. So if we're in a world where more options are being traded, there's more passive money, the quants have all gone momentum, there's nothing else that works. Are you in the David Einhorn camp that something is broken about this market?
Yeah, I think passive's taken too much of a role. You have, I think, the options, the need for this daily trading of options. I think, again, a lot of these things, I think what it's going to do is suppress vol on a day-to-day basis because so many people are selling it for income. And then you're going to get these huge gaps. So if the world's kind of a zero-sum game and people are winning more and more, but smaller and smaller amounts, when you get the loss, it's going to be bigger. So I think you want that downside protection because I think we are susceptible to these large, quick, 4 to 7% moves in a period of a week. We may continue to grind higher, but yeah, if something feels broken, the other thing, I think we mentioned it before, but NVDL, it's a 2 times leveraged stock on a single stock. I don't understand why we proved an ETF that gives 2 times leverage on something that's very volatile like that. You actually have this, even if it goes unchanged, but you get this movement, the investors in that will lose money. And if you can't afford to have a margin account, why do you need to play a single stock double leverage? So I think we've made mistakes like that in terms of the products we've allowed to go through, and it's problematic. And it's one reason I think so many people are questioning this market.
Take me to the inevitable outcome of that. Is it Volmageddon 2.0?
I don't think it's anything that crazy. I think there's money there. There's real stories behind these companies. It's not like maybe when we saw 2020, 2021, where stocks were just going up every day. They had no earnings. There was nothing. These are real stories. AI is growing. I think things have got ahead of itself. The story you pointed out earlier, in my own experiences, you try and use it. And by the end, sometimes it's great. And then by the end, you've fact-checked a few things. You've done enough. I'm like, I could have done this myself almost as quickly and learn something. That's the problem, right? As you rely on AI, I think, what do you actually learn and how do you come at your next approach? And so that to me is one of the concerns. So I think there's this AI, everyone has to talk about it. A lot of it's, I think, just simple programming. It's not AI. Some things seem like they should be obvious. It's going to get there. I think the market's got ahead of itself. And last week was the first time I had kind of the real bulls even seem to question. So that to me is an interesting change.
Let's talk about the geopolitics of this, because you wrote in your note that you have not been paying a lot of attention to European politics, but now it is actually high on your list. And you're very attuned to geopolitical and political risks. You have generals on your board. What makes you so nervous about Europe?
We've often seen these trends develop in regions where something starts and then, a couple of years later, something else happens. We had Brexit, right? And you look at some of the things that triggered Brexit, whether it was immigration amongst them, right? None of that's been addressed in Europe, and now that's what you're hearing in France. You're hearing these countries talk about that. My view is in an economic slowdown, which we could be seeing a little bit of, that's when also people turn more nationalistic, right? It's always great to point your finger at someone else and say, hey, your fault. So this kind of came off my radar screen, and I guess what caught me most by surprise is it feels that, certainly in France, it's the extreme left and right are both gaining momentum. And I think a lot of us have been frustrated in the U.S. somehow that it seems that the fringe elements get all the attention, and that's what drives a lot of policy is catering to those fringe elements. I didn't see that developing in Europe. I haven't been paying close attention, so we have that. And then I think beyond that, you see all our enemies, I think, looking, or adversaries saying, where is the U.S. stand in this? Where's the weakness? Will NATO hold together? I think you're seeing things broadly. This is the first time in 24 years we sent a note yesterday that Putin's gone to North Korea, right? That is a reasonably big change. When we mention China, everything first goes to Taiwan. Well, there's the second Thomas Shoal in the Philippines. That's getting sketchier. So I think people are looking to take advantage of this, and the political discourse is getting worse globally in the West.
I guess the flip side of Putin going to North Korea is because he's so isolated everywhere else. He has no choice but look to North Korea, which doesn't have the best of stockpiles. But yes, they are supplying him weapons. When you look at Asia, when you look at Robert O'Brien is saying in Foreign Policy magazine, what do you make of that? He's calling for a complete decouple with China.
I think that's the direction we're headed. It's, when we talk to our most plugged-in advisories, board members, there's no way we are going to do anything on AI, high tech with China. There's just no way that's coming back. I think that's now viewed as extreme national security. You take a step below that even, and more and more biotech, all the pharmaceuticals, all the other things we relied on from there. I think people are saying, whoa, what is this going on? I think we're in this awkward position, it seems, on solar panels where we want to go green. Somehow we ceded the solar industry to China, and now we're putting tariffs on Chinese solar, and it kind of makes your head hurt. So I think this is all going to separate, and people are really going to do more and more on their own, realizing that at a high level there's independence. And I think, unfortunately, China's quite fine with that, right? They are building this network of what we refer to as the autocratic, resource-rich nations, right? China does very well with the autocrats relative to us because we have principles. We have things that we want these countries to do and behavior that we find acceptable. I think China doesn't really care so long as they have a trade relationship. So they've accumulated this network of autocratic, resource-rich nations, which includes some bad actors, right? It includes Iran. It includes Russia. I think that's problematic.
So put this together, because you're talking about sort of the narrowness of the rally in the United States, the potential for political risk that a lot of people are not focused on or hasn't been priced in. What do you think is most vulnerable to a repricing as political risk becomes more prevalent in people's minds?
I think it's going to be some of this big AI spend. I think people, if we see a slowdown in spending at the consumer level, I think we see some of that. If the jobs numbers start reflecting what we saw in the household, not the establishment survey, there's going to be some concerns. Where's this economy headed? I think we're going to see a little bit less travel this summer than we did last summer. All these things are slowing. I think that will decrease spending, and then people will question, what are these valuations? And I do think we're very susceptible to some sort of a commodity shock over the summer, where on the good side, I think for a global economy, it would be India continues to grow. And, they had some hiccups after the election, but India's been on a good trajectory. They are demanding more and more commodities. China's going to do more and more. And then we have these enemies who all control commodities and don't necessarily like us. It just feels it's very susceptible as we're in the heat of the election that someone pushes our buttons.
So it doesn't sound like you're particularly bullish right now.
I'm not particularly bullish. And again, like I said, last year I loved the laggards and I thought they could catch up, and they did. I just don't see how the laggards really catch up in this market unless it's in a down market where the valuations come down on those high flyers, momentum breaks. And we've seen that so much. It reminds me a lot, in treasury trading, where I think the commodity CTA advisors really drive a lot of it. And you see people like, why does it keep going up? Why do yields keep going up? Went to 5%. boom, 420, 460, 410. And so you see these momentum trades get stopped out. I think it's been a very difficult year for a lot of momentum away from AI. You know, treasuries have been mean reverting. I think that comes down, it breaks in AI, and that's that last refuge in momentum. And that's why we would get the severe 5 to 10% pullback in a very short time again.
Peter Tchir, always wonderful to see you. Don't be a stranger. Peter Tchir of Academy Securities. Have a great time on your vacation. Let's get you an update now on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Happiness. Yahira.
Hi, Lisa. Apple is shutting down its Pay Later program after launching it just a year ago. The program allowed users to pay off purchases of as much as $1,000 over 4 installments. The move marking a retreat from Apple to offer more financial services in-house. The iPhone maker recently announced that third-party services, such as ones offered by Affirm and Citigroup, would be integrated into its upcoming iOS 18 software. Fisker has filed for bankruptcy, the announcement coming after the struggling EV maker held discussions with a major automaker about an investment, but failed to secure a deal. Fisker listed assets of between $500 million and $1 billion and liabilities of between $100 million and $500 million in its bankruptcy petition. The filing protects Fisker from creditors while it works out a plan to repay them. And NFL Commissioner Roger Goodell rejecting claims the league colluded with DirecTV to set the price of the Sunday ticket broadcast package. The NFL is facing a lawsuit from fans that want to revise its broadcast policies to allow for greater access to the games at lower prices. The NFL could have to pay as much as $21 billion if it loses the trial because damages can be tripled under federal antitrust law. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, New York crude holding above $80 a barrel as we head into the summer.
We still think the summer is going to be good. We think inventories are going to draw, so the crude market is going to be supported. But certainly there is that element of potentially moving into an oversupplied market.
That's coming up next. This is Bloomberg. Into Tuesday of a shortened week, retail sales Tuesday as markets maybe try for a 31st record high to close the day in terms of the S&P for 2024, losing some of that steam right now, basically flat 55.45. You can see that euro weakness just continuing, 107.16. 10-year yields up just marginally in crude. Want to sit on crude for a second? Up just a touch, $80.37 a gallon traded on the NYMEX. Yesterday up 2.4% as people took a look at possibly more demand as well as potentially more disruption. Under surveillance this morning, New York crude holding well above $80 as we head into summer.
We still think the summer is going to be good. We think inventories are going to draw, so the crude market is going to be supported. But certainly there is that element of potentially moving into an oversupplied market. We are in a world where there's commodities that are very sensitive to prices on the supply side and commodities that are not. And that's kind of the balance we're seeing.
Here's the latest. Oil basically flat today after hitting its highest level since late May, driven by a risk on sentiment in global markets. This comes as parts of the U.S. are bracing for a heat wave expected to bring record temperatures. Joining us now, Bloomberg's Will Kennedy. Will, can you just give us a sense of what you're hearing from people in terms of the momentum that we've seen over the past few weeks, in particular last week, when it comes to higher oil prices and whether people think it's sustainable?
It's been a strong market, and you can really see that if you look at the price for oil in the near future and oil slightly further out. Those spreads have rallied to the highest since April, which shows that there's a strong call on oil right now, that inventories are drawing down. And I think people, as Francisco was saying a moment ago, always expected this. We're moving into the peak months for demand, the so-called driving season. People are moving around the US, they're moving around elsewhere, they're flying, and that demand is expected to draw down and is drawing down inventories globally. So we're hitting a strong period, and I think that's reflected in the flat price of crude, which has come back quite markedly. But as Francisco said, there may be less certainty ahead as we get through this period. into the latter part of the year.
This is sort of the reason why maybe you're not seeing that lift follow through in the gasoline market in the United States. It's actually, you've seen declines there to $3.45 a gallon from as high recently as $3.68 back in April. I'm just wondering the significance of that. I mean, this is basically poised to shift, to inflect higher. Is it completely divorced at this point based on refineries and supplies of oil and where it's coming from versus the global market?
Well, one of the things we've seen globally is that refining margins, the profit that people get from turning crude oil into gasoline and diesel and jet fuel, have come off. US refineries are still working very hard, as you would expect, going to the driving season. But in other parts of the world, we've seen some spare capacity in China, for example, margins not strong. And I think that's reflected and followed through into the global fuel market. And that's why you haven't seen gasoline prices react in the same way that we've seen crude prices react in the last few weeks.
But what you're saying, Will, is that we're seeing stockpiles move to drawdowns. We're seeing potentially we're going to have a driving season that's going to be big and robust. On top of that, we haven't even seen hurricane season just yet. What potentially could we see trickle down into the oil market into gasoline prices?
I think the hurricane point is very well made, Anne-Marie. We haven't seen any big hurricanes the last few years, but all the indications point to the fact that we could see some very big storms in the Gulf of Mexico, and that can often have a big impact on markets in two ways. It can shut oil-producing fields on platforms in the Gulf of Mexico, and it can hit those giant refineries on the Gulf Coast in Louisiana and Texas that are so vital to supplying gasoline to the US market. So that clearly is an extra risk going through the summer months, and one reason why people may not want to be caught short in this market.
Well, is the U.S. well-positioned, should that risk come to fruition, to withdraw from the SPR after already having done so, after not having filled it up? If we get to those risks, can the U.S. mitigate them?
Well, the current administration has shown itself very willing to pull that lever. There's not as much oil as there was in the SPR, but I think there was an interview by the Financial Times with Amos Hochstein of the administration earlier this week, where he said that the administration would be willing to pull that lever in the months ahead, that their priority is to keep gasoline prices low for consumers, especially running into the election in November. So I don't think you can rule it out, Danny, but there is a lot of resilience in the US system before you get there, and I think it would have to be a very severe disruption before that happened. But at the end of the day, that's what it's there for. It's a strategic reserve to smooth out disruptions in the market. And if you've got a very strong hurricane, which took a lot of oil offline or a lot of refining capacity offline, and we saw prices spike, that option is clearly there.
That's on the gasoline side of things, Will. I do wonder what you think about natural gas and some of the other utilities costs just generally as we do head into a hot spell. A lot of people say it's always hot, it's summer, but this is a particularly hot spell. We're talking about record highs across the Midwest, headed to New York City. Today, it should start. We're all very excited. Will, do you have a sense of how this will sort of show up in energy markets more broadly and frankly for consumer bills that have clearly factored into how much money they have left over for retail sales, which we get in about an hour time?
One of the trends we've seen globally in energy over the last few years is that this difference between demand in the summer and the winter has lessened, because obviously heating demand in the winter has come off a little bit as well as get warmer, but demand in the summer has gone up because people are just having to run their air conditioning units harder and harder. And we'll see that as we go into this heat wave. That will produce a draw on natural gas. I mean, the US Northeast it generates energy in lots of ways, but natural gas is one of them, all down the east coast of the US. It will draw on natural gas, and we have seen a rally in natural gas prices. They were extremely low in the spring, and people, why there was a glut. We saw some producers curtail production, and then this will drive demand higher, so you will perhaps see those prices continue to come up.
Bloomberg's Will Kennedy, thank you so much for being with us. It's a real question. I mean, every year people have been talking about how hot it gets and then how this will really factor into utility bills. But it's not just gasoline, Anne-Marie. It's also the amount that people are paying on their monthly bills that really does crimp their ability to spend elsewhere.
Absolutely. For electricity, when you're thinking about this heat wave we're going to see, Manhattan Central Park set to reach 98 degrees Fahrenheit on Friday, according to the National Weather Service. And then that heat is just going to spread upstate New York, the Midwest. It's going to be a massive week for a heat wave.
And they have cooling centers, and people are trying to, go to movie theaters, go to the beaches, try to figure out exactly how to toe this line. I mean, it speaks to something Peter Tchir was talking about, though, and to your point, Anne-Marie, about a possible disruption. How far away are we? How vulnerable are we to an increase, say, $10 a barrel or something like that, to really cause something in a dent?
Well, then the concerning thing he pairs with that is the geopolitics of it all, that these commodities are in large part held by adversaries of the U.S., that India is consuming more. So you put all of these together, do you worry about something more pernicious?
Coming up, we're going to be speaking with Bank of America's Marci McGregor on why the bullish market will continue regardless of all the fears that we've just been laying out. This is Bloomberg. Coming into Tuesday with air soaked in uncertainty, the Patrick Harker quote of the morning. Emery will get to that in 1 second. Markets basically don't know what to do with that because how could you basically flatten the S&P? Do we get a 31st record high of the year? Right now we're looking at NASDAQ futures eking out a gain, as that is not a surprise to people given the leadership that we've seen in the Russell 2000. Also not a surprise, down about 0.3%. When you push it through the bond market, this is interesting. And Danny, yesterday I thought it was interesting. The sell-off that we saw that was paired with issuance of corporate debt. This idea that people sold treasuries to go into some of the corporate issuance that was happening pretty much across the board.
Part of the reason I think it's also interesting is last week was so quiet for corporate issuance, and there's this feeling that we're getting a lot of rate volatility. Things are uncertain. So corporates are starting to pull back. Well, yesterday proved us that that was all wrong, that there is still this huge demand, not just to issue bonds, but to also absorb them, hence the sell-off. So things all fine and dandy for corporates, even though we don't know what the cuts will be, we don't know what the data will be, and we're all confused.
Which is the reason why, Anne-Marie, air soaked in uncertainty.
As he was placing his dot at last week's FOMC meeting, and kudos to Andrew Hollenhorst for pulling out the most interesting color from that speech. Basically what he said is that if all happens to be forecasted, I think one rate cut would be appropriate by year's end. Indeed, I see 2 cuts or none for this year as quite possible if the data breaks one way or another, which is why people are so data obsessed, because the Fed is data obsessed, and which is why I'm excited for retail sales.
Yeah, although then people will explain why we should or shouldn't care about it. So the air soaked in uncertainty ends up continuing that way, which you can see euro a little bit weaker versus the dollar, under surveillance this morning. More trouble ahead for Boeing. A new whistleblower alleging the plane maker mishandled and lost track of hundreds of faulty parts that may have ended up in new 737 MAX jets. I tripped over myself because I have to admit, Danny, I hate this story. I hate talking about all the problems with Boeing planes. I hate talking about the idea of faulty parts going into planes that we fly. And I just wonder what structurally has gone wrong, where there are these whistleblowers that still have what to say that hasn't been heard already.
And it's remarkable that this has been going on for how long? I mean, even before the Alaska air door incident, we knew that there were problems with Boeing, and it is uncomfortable. It's uncomfortable every time you have to get on a plane and you look at the little thing on the seat behind you and say, oh, 100%. I'm going to be honest, I do that, and then I put an eye mask on and try to go to sleep and not think about it.
Well, that's right. I mean, do you look and see, and then you just basically decide not to fly, or you fly?
I did on my most recent flight. I happened to see that I was flying on Boeing. I had a moment of a thought, and then I put my earphones in, and I just said, well, I have to get home.
Yeah.
What struck me about this story is that what these non-conforming parts are, they're damaged or inadequate components. They're supposed to be tracked, disposed, or repaired, and meticulously recorded. None of that seemed to be happening. And what I have a question for, and I'm sure a lot of senators today, when they skewer the CEO, are going to have questions about, is if this is what we are starting to know, what is still happening under the hood that we still don't know about? What more whistleblower reports are going to be expected?
And I also want to understand exactly what the casualties are of the pandemic era, where a lot of people retired who had institutional experience, where you had people who weren't paid as much as inflation was increasing, and you had a real shift in terms of the population of workers. How do you change that? And that's one of the reasons why maybe people don't want to get in and be the CEO.
I find this so remarkable, the Journal reporting that some of the lead candidates for this, like Larry Culp of GE, don't want the job. but you need to have a really coherent thing of how you fix this beast, because it is a beast of a company. It's huge. I remember Calhoun told Guy Johnson, essentially just saying, we need to stay disciplined. I mean, that's not enough. That doesn't make me feel safe in a Boeing just to hear the CEO saying, we need to stay disciplined, because what, you weren't before?
It should make you feel safe that we are in air-soaked in uncertainty. I'm talking about Philadelphia Fed President Patrick Harker, who's seeing one rate cut this year. Harker saying that he's looking for several more months of improving inflation, plenty more Fed speak coming today as investors await retail sales data out in an hour's time. You do wonder the relevance of some of the commentary, considering that they don't really have much confidence. Air-soaked in uncertainty, key example. Nonetheless, Anne-Marie, it's interesting that the rhetoric shows it wasn't an aberration that the Fed coalesced around one rate cut this year. It was definitely some kind of lack of conviction that was even in some people who had been previously somewhat dovish.
Absolutely. That's why this is so interesting, because it does feel like they have this lack of conviction. And everyone who's saying, well, when that inflation print hit just before it, potentially this is going to give some of that support the Fed may mean to want to say, okay, we see the soft landing. We are going to start to potentially make a cut. And they actually came out more hawkish and said it's not going to happen until December. It feels like the whole FOMC moved more towards the Neil Kashkaris.
Which I find, which is interesting because it's coming at a moment where people don't care. And basically people all shrug this off and they are unabashedly optimistic, at least about stock market returns. The latest Bank of America fund manager survey found that investors are now the most bullish since November 2021 and are likely to keep pumping money into record-breaking stock markets. Marci McGregor of Merrill and Bank of America Private Bank writing this: we see catalysts for the bullish trend in markets to continue. We view any pullbacks as a buying opportunity. We anticipate markets to feel choppy in the coming months as markets may take a breather. A lot to digest there, Marci, joining us now. And just want to say, Marci, so good to see you. Thank you for being with us. We know that you're not responsible for the fund manager survey, but you do help to understand and interpret it for the clients that you advise that oversee something like $3.8 trillion in client balances. So not a small pool of cash. How do you have the conviction to be bullish at a time where there are so many people who feel like this is getting narrower and narrower, with the most crowded trade being the Magnificent Seven?
Well, thanks for having me. Of course, we want to see this market broaden out. And there's reason to think that the market may feel choppy over the summer, especially as we enter election season and the Fed is battling this last mile of inflation that's giving them a bit of a headache. But when I think about the ingredients for the overall bull trend to continue, we have a lot of liquidity in markets. Financial conditions are easy. We have a solid earnings backdrop that we think will broaden. If you look at this market, so far the S&P year to date has been driven by earnings, not multiple expansion. So that gives me confidence. Also, we're seeing bond yields. I think they'll stay pretty range bound, but they've been making lower lows and lower highs. I think that's a positive for equity markets. And then finally, we can't discount the innovation that's pervasive in the economy right now around artificial intelligence. So I think the bull trend continues. It may feel choppy. We may get a pause here in these early summer months. And what we've been saying to clients is this bull may turn into a buffalo and start to roam a little more, but I think the uptrend is intact.
Well, whether it's a bull, whether it's a buffalo, whether it's a cow, Marci, what we see is an air of uncertainty. And that's what we were talking about with Patrick Harker, this issue that Fed officials themselves don't know how to read what animal that we're looking at. And so it raises this question of where do investors get the conviction that they understand at a time where people are still debating whether 10-year Treasury yields, as we had earlier from Lara Rhame, of FS Investments, going to 5%, or are they going to 3.5%, like what we heard from HSBC's Stephen Major? Marci, how important is that to you, given the bifurcated calls that we're hearing all across Wall Street?
Well, in the near term, I think the path of least resistance for rates is probably lower. But when I take a step back and look at the economy, our view is that the economy is moderating, but very slowly. And I think that'll be music to the Fed's ears. If you see, we've seen pockets of the economy like, retail sales, like housing, like manufacturing data showing some slowing. And then we have a really strong labor market that I think under the hood is normalizing a bit. But it's still pretty strong, giving a tailwind to the consumer. The bottom line with the economy, though, is it's hard for me to get overly bearish when there's so much fiscal support that's creating quite a cushion for this economy. So while I think the economy is going to moderate slowly, it's going to allow inflation to start to trend lower. But I think at the end of the day, we may have a higher resting heartbeat for inflation for some time. So inflation that stays somewhere above 2%. but a Fed ultimately that gets the confidence to cut this year. The Bank of America view is one cut in December. I do think there is a risk based on data that, that could be two. But ultimately, I think you're going to have a Fed that keeps telling us to be patient. They need a couple more inflation prints before they gain the confidence to cut. But when the Fed's data dependent, the market hangs on every data point. Once we get into the next earnings season, though, I think the confidence will come back to investors with this bull market trend to continue.
Marci, it does feel like unbridled optimism for earnings, though, especially if it is a slowly moderating economy. For next year, for 2025, the estimate for earnings growth is 14%. That would be the best year, if you exclude the COVID weirdsies of 2021, since 2018. Does that sound right to you, 14% earnings growth for next year?
I think that's a little bit optimistic. I think you're going to see that revised lower. But the key here, I think, is earnings broadening. So the other 493 companies starting to really pick up. Now, we're seeing early signs of sectors and industries starting to join the party that's really been, of course, led by tech and the Magnificent Seven. I also think it's going to be important to the earnings story that you get small caps in the party. I think we may see an inflection point here where small caps start to show a little more green shoots on the earnings front as we look ahead to 2025, and may even start to outpace their large cap peers. So the broadening story, I think, is going to be really, really important to reach any of these optimistic earnings estimates. But I would expect, I think that for the consensus is a little higher now for 2025. So I could see that coming down a bit, but broadening is going to be key here.
Potentially, we will see that broadening out then, Marci. You mentioned two things. One, uncertainty around the U.S. upcoming election. Also, you meant the fiscal support we've seen out of the United States. Do you see any sign of that abating?
What we typically see in a classic presidential election year is the VIX spikes by about 25% from July to November. So that choppiness isn't going to surprise me. And of course, volatility is at really low levels already. But once the election is past us, I think markets return to fundamentals, which do include policy. A lot of this spending has a bit of a lag to it. When we think about the defense spending that's been earmarked for this red hot geopolitical world that we're in, a lot of those dollars get put to work in the U.S. If we think about the infrastructure spending from a couple of years ago, that is more of a medium-term support to the economy. So it wasn't all put in the ground right away. I think ultimately that's going to support construction, transports, machinery, investments kind of in the old economy as well as in a green economy. So I think there's some legs to this. It's hard to see right now any will in Washington to turn the fiscal faucet off. So I think there's a chance it could continue.
How much are you concerned about what we're seeing in terms of the fiscal overhang, the deficit? And we've been talking about this. We were just talking about it with the New York City head of the investments for public workers. He's concerned about it. He sees the sizes of auctions going up as significant. He thinks that at some point you could see pushback in markets akin to what we've seen in Europe. Is that something that you see on the horizon or that you're advising clients to be aware of as they come up with the new 60-40, whatever it may be?
This is the number one question I get at client events is concerns around the debt and deficit. And I do think my main concern with it is that it could dampen future growth. It could be stealing from the future. It could drag on growth. It could drag on future spending. But when I think about it as an imminent issue, our colleagues at Bank of America Global Research did some fantastic work on this and found the weighted average coupon of the national debt right now is about 2.25%. As long as that stays under nominal GDP, and of course that's well under nominal GDP right now, and we don't expect that to change, that would be the inflection point where we would start to get more concerned. So we have a bit of room there, even though the overall picture of the growing debt is a bit concerning. Realistically, I think my concern is that this could borrow a bit from the future, could put a bit of pressure on the private sector to boost the economy going forward. But ultimately, I'm not concerned that we're at a tipping point right now.
Well, this is the thing, right, Marci? It's fine to spend, but it matters what type of spending and how much growth you get from that spending. We hear the language coming out of France and deficits there, that the type of spending that they're doing can reignite the economy and make up for it. When you look at a global picture, Marci, are we in an over-leveraged world, and can growth keep up with the type of deficits that countries are running?
Well, in the post-COVID world, clearly the gorging of spending has been happening on the government level. We're not seeing it in corporates. We're not really seeing it on the consumer balance sheet, which we're still seeing is really healthy. In fact, our internal data is telling us that deposit balances are still about 40% above 2019 levels. So we didn't see the excess on the corporate or consumer side. We did see it on the government side. So it's something we need to watch closely. I think it's a risk. It's a risk, again, in terms of going forward, will Washington have the will to spend? And you're absolutely right. You want to see government spending on areas that can add productivity to an economy, and that does not include interest income. So what the government spends on, anywhere in the world matters. We did see some of this spending go to areas that could add to productivity around research and development, infrastructure spending. Those are all areas that I think could boost the overall productivity of the economy. Interest income, like I said, is not one of them. We're not at that tipping point just yet. Clearly yields coming down will be music to the Treasury's ears.
Marci McGregor of Merrill and Bank of America Private Bank, thank you so much for being with us. Great to hear from you. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with the one and only Yahira Hackes. Yahira.
Hi, Lisa. Get the Geek Squad ready. Best Buy is preparing for one of its biggest product launches of the year, AI computers. The retailer is set to be training more than 30,000 employees to sell and repair PCs equipped with Microsoft's new Copilot AI, which go on sale today. Best Buy says it has exclusive rights to more than 40% of Copilot PC models. Bitcoin touched a one-month low in early trading. The cryptocurrency is being weighed down by the prospect of higher for longer U.S. rates and outflows from digital asset investment products. It fell as much as 2.7% this morning, touching levels not seen since mid-May. Smaller tokens, including Ether and Solana, were lower as well. And the Boston Celtics are back on top. The Celtics beat the Dallas Mavericks in the NBA Finals, led by their star duo Jason Tatum and Jaylen Brown, taking the series in 5 games in front of the home crowd. It's the franchise's first title since 2008. And the Celtics have now passed their arch rivals, the Los Angeles Lakers, for the most titles in NBA history. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Steve Pagliuca, just want to tell you you're winning life, and every day we are reminded of it because the Celtics, his team, and it's just yet another of his
and his
portfolio.
Football team as well in Italy, Atalanta, plus the Celtics. I mean, who's having a better year than Steve?
Well, come on and make us all jealous of you, Steve. Up next, the Ozempic effect.
The AI theme has been applied, and it's almost turned into a macro story, right? That this is going to create, higher productivity in workers, and you're going to get a GDP growth that is higher than you might have assumed. GLP-1, which we've talked about, also kind of fall in that category.
That's coming up next. This is Bloomberg. We're still talking about the Celtics right now as markets search for direction after 30 record highs in 2024, led by big tech. Meanwhile, what we see is a lot of questions about when that will shift, including potentially some of the other trends other than, for example, AI, like Ozempic. Under surveillance this morning, the Ozempic effect.
The AI theme has been applied, and it's almost turned into a macro story, right? That this is going to create, higher productivity in workers, and you're going to get a GDP growth that is higher than you might have assumed. GLP-1, which we've talked about, also kind of fall in that category. So yeah, I mean, there are some big assumptions being made. What does this do to kind of longer-term trend economic growth, and what does that do to your kind of long-term view?
Here's the latest: the GLP-1 revolution playing out in retail. The Wall Street Journal reporting customers are downsizing on clothes and renting the smallest sizes in 15 years. Sucharita Kodali of Forrester Research joins us now with retail sales just over 30 minutes away. Sucharita, let's talk about this. I read this story and I thought to myself, is this really true? Can we really attribute people looking for close-fitting types of dress wear, et cetera, to the Ozempic effect? Do you see this as truly having legs and actually shifting retail sales going forward?
Yeah, when you looked at the story, even the data that they cited said that it wasn't necessarily a clear correlation. It is likely just the fact that people during the pandemic purchased a lot of larger size clothing because they were at home. They may not have been working out as much. They may not have been as physically active. And now they're just back to their regular routines. I think that there were some speculation that Ozempic was the reason, but it was more a correlation, not causation.
Is there something interesting, though, Sucharita, about the numbers that you've seen in terms of just how much people are going back to retail, how much people are going back to shopping for clothes in a way that a lot of people said that they wouldn't after the pandemic, and frankly, even before that, when people saw a real selectivity and greater discretion among consumers?
Yeah, this entire retail economy post-pandemic has been very, very curious because the retail sales numbers have been at all-time highs. And until the last few months, they've even exceeded inflation, which suggests that the number of units that people are purchasing across categories, not just sectors like apparel, but a lot of essential goods like food categories, consumer packaged goods, the mass merchants were doing particularly well. And it was at odds with this consumer confidence set of numbers, which were entirely down. And that's the reason that we have that expression, the vibe session. People feel one thing, but they're actually doing another. And that's what we're seeing in the economy. Only now, I expect probably the numbers today to have a little bit of softness and probably be at the level of inflation, possibly even less.
Can I ask about social media? I know this question is a little bit out there, but I am a user of the Reels, of the TikToks amongst all the kids. And I feel like I open up my phone every day and I see a new fashion trend that I'm supposed to be latching onto. Like apparently now I'm not allowed to wear ankle socks because it shows that I'm a millennial. Now it seems like the fashion, it's a real thing. Lisa's given me eyes. It's a real thing. It shows that you're a millennial now. Yeah, if you wear low socks, it's clear you're old. Does this show a faster fashion cycle that's getting people to go out and spend more? Is it having any real discernible difference?
That is probably the bigger thing. They're not just the social media, but companies like Shein and Temu, which have sort of come out of nowhere. They've paid a ton of money for online advertising, acquired so many consumers, and they have super, super cheap prices. So they're able to get people to purchase at a faster rate, too. I mean, certainly the lower a price point is, the demand curve is going to have you purchasing more units, and that's absolutely happening. And that's something that is unique and curious about the apparel industry in particular. It's one of the few product categories in consumption where the average price point has actually gone down and has barely kept up with inflation. So that's definitely one of the things that we're seeing is more of these really inexpensive units being purchased and some of these Chinese sellers being the places where we're purchasing.
Sucharita, I was struck by something you mentioned in your note, the fact that Kroger, the U.S. grocery behemoth, is in Cannes, France, the south of France. Why?
Yeah, I thought that was really interesting, too. So Cannes Lion is the big advertising and media industry conference that happens, on the French Riviera every year. And normally you expect the companies like Meta or Google or, flashy advertising agencies and media companies to be there. But Kroger actually has a pretty strong presence there this year. And the reason is because they are trying to pitch their retail media business. Retail media is advertising on a retailer's website, in their properties, and Kroger is trying to get a piece of the advertising pie that Amazon Ads has essentially established for the retail world.
Sucharita Kodali of Forrester Research, thank you so much. I am now going down a rabbit hole about ankle socks. They've evidently been canceled.
It's a thing.
I'm really upset about this.
No,
why?
They'll literally make TikToks like filming people on the streets and being like, I can tell if they're a millennial or a Gen Z or a Gen X, depending on what socks they wear.
But it's very specific. It's not about them being canceled. It's about a new fashion where the socks go up to mid-calf.
Crew socks.
Yeah, but what's the thinking here?
I guess they're back.
Why? Where did they go? I don't know.
Well, I just am wondering. There's something about, the sort of clean look of if you wear shoes that have that. Anyway.
I feel like you're getting somewhere, Lisa. I see it working.
I'm just, it's a heat wave. Why is everyone wearing socks?
I agree with you.
It's sandal season. Just don't wear socks with sandals.
Okay,
that's a rule everyone agrees with.
That's actually not true. Haven't you seen the Birkenstocks with crew socks?
Good point.
I'm sorry. Anyway, this is quite the fashion discussion. Our sartorial leader evidently is gone out, and we are making it up as we go along. Coming up, David Lebovitz of JPMorgan will save us, not talking about crew socks. Ian Shepherdson of Pantheon Macroeconomics and Gregory Daco of EY, as well as David Rubenstein of the Carlyle Group. Yes, Anne-Marie?
No, nothing. I'm just saying I'm not making it up. Definitely don't wear socks.
Is that what you're hearing? Honestly, let's move on. What we are seeing right now in markets is potentially another day of record highs, although off that, basically range bound. And what I'm seeing right now in yields, marginally up. I'm seeing in crew socks is people telling me to get rid of them all, which is really annoying to me because socks are expensive if you get good ones. And I don't want to throw out ones that I like.
I have so many low ankle socks, literally, that I will hold up retail sales on my own by buying new socks.
We're going to let this go. We're going to let this go after this. This is Bloomberg.
Market this week wants better data. It wants to be assured that the economy really is strong.
The incoming data has been unstable enough that has kind of reflected itself in the instability of the markets.
This is a normal economy. You're not going to make straight A's every quarter. You're going to have some weakness here and there.
Risk assets have just cruised through this whole thing, and they ignore the volatility.
I think in general, looking at this all very holistically, it's really going the way that the Fed would like it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
30 minutes away from understanding just how many socks people are buying in order to update their crew sock holdings to something more fashionable, maybe to wear with Crocs or, potentially Birkenstocks like Anne-Marie Hordern. Welcome back. This is Bloomberg Surveillance. She is horrified to think that potentially anyone would catch her dead wearing sandals and socks. We are 30 minutes away, 29 minutes away from retail sales at a time when a lot of people are focused on the narrowness of leadership, and we're not talking about socks. We're talking about the equity market rally and just how much consumers can keep spending on things other than socks, but also just their natural expenses that have gotten so much greater.
Yeah, I mean, you had this moment where inflation went from 9% to something more like 4% in the span of a year. Then it bumps around 3 to 4%. So you don't have that real income gain that you once did in the year past. At what point does that finally start to make people feel not just poor, but finally unwilling to go out and spend?
Which has been a huge question mark underpinning, frankly, this vibe session that we keep talking about. At a time when we have a lot of people, the data on Friday, University of Michigan Sentiment Survey coming in, much weaker than expected, with some of the underpinnings really highlighting it isn't just inflation. It's also that people are not as confident about their job prospects at a time when we're still seeing record highs.
Right, so they're feeling it on both ends. And I think what we all agreed, what was so interesting about the Michigan report was the director coming out from the survey saying that the middle class, for the first time really in a really long time, historically you don't see this, they're starting to feel like they are part of the lower economic income level. And that is very concerning. I was struck by what Paul Donovan had to say this morning, the chief economist at UBS. He said U.S. retail sales numbers are due and U.S. consumers should continue to spend money they do not have on things they do not need. However, an anecdotal evidence suggests U.S. consumers are more price sensitive and refuse to spend in the face of price increases. And that really, I think, mirrors what we heard on Friday from the Michigan survey.
Which highlights how confusing this moment has been. And you talked about how you're confused. Patrick Harker is confused. Anne-Marie, you pointed to this, that in his comments yesterday, he said that he is surrounded by air-soaked in uncertainty. Thank you to Andrew Hollenhorst, the team over at Citi, for highlighting this. But I am wondering, Danny, how much this sort of clouds how the market's going to respond to retail sales that are expected to soften. But it's unclear exactly how to interpret it at a time where some people, like Lara Rhame, are telling us, ignore it.
Yeah, I mean, it is a moment in time where it seems like the Fed, their uncertainty, their default is just to do to dots for just one cut so far this year. But the market doesn't believe that. The market's been pricing in 2 or 3. That's what the fund manager survey also showed us. It's almost as if the Fed is overcorrecting for what they did in December. That uncertainty played out in them saying, unleashing this verbal cut to the market, Powell talking about it. Perhaps they're living with those scars and are very concerned about getting excited about the data. So maybe even if they had all the data in hand today, be it the CPI, the PPI, maybe even, who knows, a softer retail sales, maybe they still would have put in one cut.
Yeah, well, this is something that we keep parsing through, and that's why we'll be listening to the 6 Fed speakers that come up today. Right now, in markets, not doing a lot. Session is young. We saw this yesterday, too, kind of waffling around, and then into the close, really rallying. The interesting thing to me is the ongoing outperformance of big tech. You've seen that so far year to date. The S&P's overall gain, 15%, almost that. Equal weighted, 4%. Russell 2000 down again today, down on the year. What we can see is dollar strength on the margins continuing, just because where else are you going to go? The euro 107.16, following some of the political turmoil surrounding France in particular. Yields higher, and we've been watching this with respect to some of the corporate issuance and how much that takes away some of the demand for benchmark U.S. government debt, 429 on the 10-year. And crude kind of bouncing around here after hitting the highest levels going back about a month, $80.28 traded in the NYMEX. Coming up, David Lebovitz of JPMorgan with U.S. equities continuing to break records. How much can you pile in? Ian Shepherdson of Pantheon and Greg Daco of EY with retail sales on deck. Do we get some clarity from all of that? But let us begin with our biggest big story. Mega caps lifting the S&P 500 to its 30th record of the year, with U.S. retail sales data due in about 25 minutes. David Lebovitz of JPMorgan writing this: we take the Fed at their word and believe a rate cut will be delivered by year end. But clearly this decision will be dependent on the evolution of the data. David joins us now. David, does it matter if the Fed cuts rates this year, given the fact that it basically all depends on whether NVIDIA can keep collecting cash and paying out dividends as much as it has?
So I don't know how much it matters that the Fed cuts rates before the end of the year. I think what's more important for the market today is that the Fed maintains an easing bias. You know, if they begin to say, look, the data's not cooperating, we still want to ease at some point down the road, and it looks like that's going to happen more so in 2025, I think the market will take that relatively well. Let's not forget, we went from pricing in 6 rate cuts at the start of this year to now just 1 or 2 rate cuts following the June meeting. And so I think the market recognizes what the Fed is trying to do. I think the market recognizes that the Fed is going to be data dependent. What I think would really spook the market is if you saw a reacceleration in the underlying data and the Fed came out and said, you know what, we may need to do a bit more. I think that is the big risk.
We've been talking about the volatility on the heels of a lot of data prints. And I wonder in 24 minutes time, if we get a really hot retail sales print across the board, not just in some key staples, will that affect things significantly? Will that move the dial in the narrative roulette that we keep playing?
I think that the market is in an interesting spot because we've had this kind of variety of data over the past couple of weeks. You had CPI, which looked very good. You had the most recent jobs report where, let's not forget, we added 300,000 jobs and wage growth actually accelerated. I think what the market wants to see is that the economy is coming back into balance. And so I'm not sure that a hot retail sales print would necessarily be, you know, the cat that gets thrown amongst the pigeons. But if we were to begin to see a series of hotter data prints, I think that's what would cause the market a bit of concern. To your point, the market's kind of hanging on every data point here. You think about that 15 basis point move in the 10-year on the back of the CPI numbers last week. I mean, that level of volatility says to me the market is still viewing the distribution of outcomes as being relatively wide and is looking for that broader trend before it begins to settle itself down.
If we see a broader trend of some normalization, can the rest of the market finally do well? Not just the big tech stocks. Can we finally start buying cyclicals, small caps, literally anything else but tech?
So let's put small caps off to the side for a moment. I think they're a bit of a different animal. We just finished our quarterly strategy summit last week, and one of the themes that came out of the equity sessions was that we really should see this broadening out of earnings growth into the more cyclical parts of the market during the back half of the year. I think the challenge to that view is that we are talking about a softer nominal growth environment, so cyclical is accelerating as nominal growth is slowing. To me, there's a little bit of dissonance there, but I do think when you look at the flow of earnings that these companies have had over the past couple of quarters, it does look like they're going to at least pick up relative to what we've seen as of late. Small caps, it's a rate trade at the end of the day. And, we can talk about Russell 2000 versus S&P 600. Obviously, the number of unprofitable companies, higher rates very much weigh on that dynamic. You would also want to see just, I think, more robust real growth. And that's certainly not what's coming through in the data.
For the tech players, for the time being, one of the changes we've seen is the capital intensity that has befallen all of these businesses. Usually they're businesses with really incredible margins, but all of a sudden, they're needing to find themselves spending a huge amount of money, hundreds of billions in quarters, in order to get their AI offerings up. Should that change how we approach these companies? Because for now, we're just trading them to the high heavens. But does a Meta, again, put whatever Mag 7 you want in there, becoming more capital intensive, change their attractiveness at all?
I think at the end of the day, CapEx is a necessity of productivity. And so if we're going to see this story play out that the market has been pricing in, we need to see the capital investment, and we know that it's going to happen at these companies. I think the silver lining here is there are multiple silver linings. One of them is that these companies have a ton of cash, right? And so it's not like they need to go into the debt markets, issue a bunch of, take on a bunch of leverage at 7, 8, 9%. They can basically self-fund, and that's a very powerful dynamic. The other thing is that from a valuation perspective, if you just look at the free cash flow yield on these businesses, it's still unlike anything we've seen in recent history. And so we maintain our conviction around these mega cap growth names on a price to earnings growth ratio. They don't look that expensive. On a free cash flow yield basis, they look reasonable. The PE multiple, I'm not sure that that's the best way of thinking about, what these companies are worth over time. And so as long as they're generating cash, as long as they can self-fund, more and more of them are paying dividends. We like that play in U.S. equities.
Potential macro headwinds is coming from the political stage, and you write about this in your note. Do you think some of this is overdone in Europe?
So I do think it's a bit overdone in Europe. And, I always think it's important to separate signal from noise. And the reality is today we have a lot of noise and, frankly, no signal. Right, we're going to learn more here as we approach June 30th, and then obviously we have the UK elections sandwiched nicely in the middle, the second round of the French elections on July 7th. We don't know anything until we get to that point. But I think what markets are dealing with is really the crystallization of risk. And the way that we're thinking about this is it's much less about what's happening on the right. And we don't really think that the probability of Frexit, if you will, is terribly high. We're more concerned about what's happening on the left and kind of this drumbeat of unwinding all of the economic reforms that France has gone through under the Macron presidency. To me, that would put France going head to head with the EU and bring us back to a situation not unlike what we saw following the financial crisis.
So what could be the impact of that on markets?
I think you'll see the bond vigilantes reemerge, particularly in Europe. This is becoming a debt and a deficit issue more than anything else. And like we saw in the U.S. last summer when the 10-year went to 5%, as we saw in the 90s under the Clinton administration, right? Bond markets can push back against government spending. And I think that that's probably the next shoe to drop if things there don't take a turn.
Do you think people were not paying attention to this? I mean, this risk has been brewing for years, if not decades. Why do you think so many people were caught back-footed?
I think the reality is that markets don't focus on politics until they do. And, markets had plenty of other things to chew on between inflation and policy shifts. I think there was a lot of excitement. Oh, the ECB, they're going to lead us down this road of better policy or more accommodative policy. And then it was like, oh, man, look what's happening over here. Well, this isn't all that good. And so it's just injected that volatility back into the market. Usually markets pick up on political issues about 3 or 4 months in advance of the election date, if you will. And so we think that, they cut it a little bit close, and calling a snap election certainly was a bit of a glass of cold water over the head. But I think the reality of the situation is that the second half of this year is going to be very much characterized by politically driven volatility. Because when you look around the world, right, we saw it in Mexico, we saw it in India, we saw it in South Africa, now we're seeing it in Europe, and then we have the fireworks here in November.
There's a real question here about where political volatility will hit the hardest. Will it be the bond market, or will it be the stock market, given the leadership of some of these stocks that have real business models and real cash flow that really cannot be undermined by simply some belief or concerns on the political front? I was looking at Bank of America data showing that government debt globally has risen 40% in the past 4 years to $97 trillion. How is this shaping how you allocate or where you see risk as holding now versus, say, 4 years back?
So the short answer to your question is I think it shows up more in the bond market than in the stock market. And one of the conclusions we came to following our strategy summit last week was we actually wanted to move to a slightly short duration stance. We had been neutral on duration up until this point. Given the volatility, we just didn't really want to find ourselves on one side of the line or the other. We sat down after the 2 days and we said, look, the 10 years trading 425. We've had a couple of very cooperative data points. It feels like, markets are doing the thing where they extrapolate these data points into the future. But let's look at what's coming down the road. There's an election where in the U.S., both candidates are going to run on more spending. That additional spending is probably going to materialize over the course of the next few years. And frankly, we're running a 7% deficit in a non-recessionary economy. And so this is going to be a bond market issue, and it's going to be whether or not the bond market decides to stand up and say, you know what, we're only willing to finance this type of behavior up to a certain point.
When do the bond vigilantes come back in? David
Exactly.
Lebovitz, wonderful to see you. We'll keep the commentary on stocks for another day. David Lebovitz of JPMorgan. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hakis. Yahira.
Hi, Lisa. More trouble for Boeing. The plane maker may have installed bad parts in its 737 MAX aircraft, according to a whistleblower. A Boeing quality inspector alleging the company mishandled and lost hundreds of faulty parts for the planes, some of which he fears may have been installed on new planes. This is according to allegations made public by a Senate subcommittee, and comes as Boeing CEO Dave Calhoun is scheduled to testify on Capitol Hill today. Apple is shutting down its Pay Later program after launching it just a year ago. The program allowed users to pay off purchases of as much as $1,000 over 4 installments. The move marks a retreat from Apple to offer more financial services in-house. Recently, the iPhone maker announced that third-party services, such as ones from Affirm and Citigroup, would be integrated into its upcoming iOS 18 software. And France got their Euro 2024 campaign off to a strong start, beating Austria 1-0, but it may have come at a significant cost. Star striker Kylian Mbappe suffered a broken nose in the match, leaving him in doubt for the rest of the campaign. The French football team said a protective mask will be made for their captain, but his status for the rest of the tournament remains unclear. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I can't look at those pictures. It's just
So
horrible.
bad.
It's just awful. This flattened face. Oh, it's terrible.
But speaking of French politics, he actually weighed in on Sunday night, telling the youth that they need to come out and vote, not accept extremists because they're at the gates of power. He wasn't saying who they should support, but he was saying you should go out and vote.
Would have been cooler if you'd done that with a bloody nose. That would have been much cooler.
Moving on. Up next, we've got the morning calls plus the state of the housing market with Bloomberg's Drew Redding. This is Bloomberg. Minutes away from retail sales as we try to gauge the consumer amid a sea of confusion, otherwise underlying strength when it comes to spending, at least when in AI. Right now, the S&P just bouncing around this 55.47 level as you do see yields just marginally higher. Not a lot going on ahead of this print that we get in just 12 minutes of time. Time for the morning calls. First up, JPMorgan raising its price target on Apple to $245 from $225 with an overweight rating. The firm boosting its volume outlook for upcoming iPhone 16 and 17 thanks to, you got it, artificial intelligence. Next up, Rosenblatt boosting its price target on NVIDIA to a street high of $200. That's up from $140. The analyst expecting new chips to continue driving value in market share. And finally, BMO Capital Markets upgrading Kroger to outperform. The analyst saying that the merger with Albertsons is a win-win scenario, even if the deal is not approved by federal regulators. Kroger set to report earnings before the opening bell on Thursday. Kind of a fascinating call that I'd like to dig more into. And after the closing bell today, we'll get results from KB Home. Bloomberg's Drew Redding joins us now for a preview. The home sector has been really interesting. We've seen a bit of concern, at least in the recent Lennar earnings, that even though orders were up in this quarter, going forward, maybe not so much given 7% mortgage rates and some of the incentives they've had to give to consumers. How much is that trend of home builders being able to lower costs for aspiring homeowners kind of run out of steam as we've gotten longer in this post-pandemic phase?
Well, I think Lennar's results show us that buyers are still responding to financing incentives. I think the issue you get into and what investors are really paying attention to is what is the impact on gross margin going forward. And part of the reason why I think there's a little bit of a negative reaction to Lennar's results is because they guide it for their third quarter gross margin below expectations, and that's going to require a significant ramp in the fourth quarter in order for them to meet their full-year guidance. So it's not necessarily that the incentives aren't working to get buyers into the door. They are. It's the fact that that comes at a cost.
At this point, how much are we seeing home builders kind of already bake in terms of their valuations, that margin compression versus still have a rude awakening ahead?
Yeah, I think there's actually has been a lot of optimism when we look into the second half of this year for gross margins to expand. And a lot of that had to do with the fact that interest rates were lower when we started the year. So the thought was they'd be able to pull back on incentives and that would support their gross margins. They're also getting better fixed cost leverage as you get through the year. But now that it kind of calls that into question as rates have come back up, and we think that you're starting to see maybe a rebound in incentives. Now, rates went as high as 7.5% not too long ago. They're back down to 7 now. So there's a lot of volatility. So I think results are going to continue to ebb and flow with what we're seeing in the rate market.
Is there a sense, if we are seeing a weakening of the consumer, that we could see places like KB having to potentially cut some of their pricing?
Yeah, so builders, unlike what we've seen in the resale market, builders have been pretty aggressive in adjusting their prices to meet the market. They've done this in a number of ways. They've done it through base price reductions where they're actually lowering, the true price of the home. They're doing it through their floor plans. So they're building smaller square footage floor plans. They're building houses that are less amenitized. And then on the net pricing side, obviously, they're offering concessions, whether it's rate buy downs, closing cost assistance, or structural options to buyers.
So if that's the case, then who out of all of these home builders do you think is leading the way when it comes to actual margins right now?
Yeah, so from a profitability perspective, Toll Brothers is doing extremely well. Pulte Group is doing very well. But you have to remember, there's also business models that you have to consider. So there's certain builders who are more focused on driving higher volume sales, and there's some who are more willing to hold the line on margin and give up or not chase as much volume. So when you think of the volume builders, we're talking about the D.R. Hortons and the Lennars, whose model calls for generating, higher inventory turnover and generating a lot of cash. And what they're doing is they're applying that cash to more systematic share repurchases. And that's something I think investors really like.
One of the more interesting things about KB Home, Drew, is that they do tend to cater towards first-time home buyers or people who are trying to move up. We're trying to get signals about the consumer. We're going to get a big one today in the way of retail sales. How do we know about how this cohort is doing when we are in a world rife with people complaining that home ownership ladder is so difficult to get onto right now?
Yeah, it's a great question. About 50% of KB Home's business is tailored towards that first-time home buyer. But I think more importantly, the way we look at it is how does their selling price compare with the resale market and the other builders? So they're one of the most affordably priced builders out there, which we think puts them in a good position in the kind of market we're in. We have seen, and as you would expect, buyers in the entry level are much more sensitive to fluctuations in interest rates. So when you look at home builders on the lower end, like LGI Homes, who targets people coming out of the rental market, we're seeing relative weakness there. But perhaps, you have builders who are targeting entry level, but maybe more affluent entry level buyers, dual income buyers, and we're seeing them do a little bit better.
Drew Redding of Bloomberg, thank you so much for being with us and for that update at a time where, honestly, housing sales and just upgrades typically have driven retail cycles in terms of spending. Here's a state of play of what we're expecting in about 6 minutes' time. Retail sales, the expectation is for a 0.3% gain month over month. When you strip out auto and gas, the expectation is actually higher, 0.4% on a month over month basis. What are you looking for, Danny, at a time where a lot of people are saying it's going to be confusing given some of the warped messages from lower gas prices and some other trends?
I think really any signs of weakness. I think it's going to be another one of these choose your own adventures kinds of data sets that you can probably find what you want. But, I think, for example, getting yesterday, Apple announcing that they're ditching their buy now, pay later. I think it's an interesting sort of insight into where we are in this consumer cycle, that risky things like that, companies aren't willing to stretch outside of their comfort zone. And we're not sure how the consumer is spending. I mean, we know that they're spending a lot on buy now, pay later, and they're racking up debt because of that. So at what point does that debt become a problem for spending?
We have seen some businesses slash prices, and this is going to help consumers. So that's why I'm so interested to see where they're not. Retail sales was able to pick up. When you see the companies come out, slash prices, does that mean that the consumer feels better? They're a little bit more robust? Or do we still see a lot more pressure on them? And I think that's why this retail sales number is really important.
When you talk about the sea of uncertainty or the soup that Patrick Harker seems to be swimming in, there is this issue where Citigroup's card spending data actually came out higher, actually inflecting upward over the prior month. It really is not clear. It's sort of a question also of where are they spending? Is it all vacation or is it on some of the clothing sales that people were previously talking about? We'll break that all down right now. Heading into that, you are seeing a market that isn't doing a lot after making its 30th record high yesterday. We saw that in the S&P 500, at least at the index level, led by big tech. We are at session highs, although albeit 55.48, up less than 0.1%. Euro gaining, euro loss, losing just a touch, weakening versus the dollar as we talk about that political divide. Coming up, breaking down that retail sales data with Ian Shepherdson of Pantheon and Greg Daco of EY. Just seconds away from that key retail sales report as we toggle between optimism and pessimism around the consumer. Welcome back. This is Bloomberg Surveillance. The state of play is modest gains, modest being the operative word, on the S&P heading into the open, 55.47. The NASDAQ still outperforming, although clawing back from some of the session highs, up about 0.2%. As we do wait for retail sales, there is this question about which the surprise will be, and it is on the downside. We're just getting the numbers. Retail sales coming in month over month at 0.1% versus the expectation of 0.3%. When you take out auto sales, it actually declined 0.1% versus the expectation of an increase of 0.2%. The control group coming in also softer than previously expected, 0.4% versus the 0.5% expected. Pretty much across the board, downside surprises in terms of retail sales. What you can see is actually S&P futures getting a bid. Evidently, bad news is good news, a softer kind of tone, creating even more of a lift, possibly because there is a feeling that this is the disinflationary trend that the Fed was looking for. The revisions, before we get to the reaction in the bond market, the revisions are important. Down 0.2% in the prior month versus the flat reading that we got previously, down 0.1% versus the 0.2% that was reported last month. Ex-auto, when you take a look at what's going on with the control group, down 0.5%. That is the revised number. So all around, you put it together, this is a weaker consumer that we're seeing in this picture. And what you can see in bond markets is yields off of the session highs. They are lower on the day. If you take a look at 10-year yields, 4.24%. They are down about 4 basis points. 2-year yields down about 5 basis points. To me, there's a real question here. At a certain point, how much is this good news? And it doesn't reflect a true weakening. Danny, as you take a look at this, what's your sense that really stands out to you?
My sense is that, first of all, equity markets have already given up some of those gains we initially saw, that maybe the good news, the bad news being good news, is a little bit confused. But here we go. It's a trend now? Is it a trend now? It's not completely clear, but that's what it's starting to feel like. Another month, especially when you take the revisions in hand. Is this a consumer that is finally starting to feel the pinch? And then how does that filter in to the labor market? I think that's the transmission we need to keep our eye on to really see how the Fed's going to be reacting to this data.
Especially when I saw those revisions, that's the first question I asked myself. Is this now a trend? Are these real cracks in the consumer? And actually, you're seeing this in the polling. You're seeing this in some of the survey data. But now, potentially, in the hard data, we are seeing retail sales, the revisions, and this month, downward surprise. And to Danny's point, is this now a trend?
And what you can see when you bleed this into some of the 3-month average annualized figures, you can see them coming in as a result of some of this data. We will be parsing through it. Michael McKee, our fearless leader when it comes to economic data, is not here. He is off for today. But we will keep digging through the numbers and get you some of those details about where we saw the declines most significantly. Ex-autos really does stand out to me in terms of how much that did prop up some of those retail sales. Right now, I want to bring the panel in because they probably have a better sense of this. And both of them have actually been on this disinflationary trend where maybe the balance of risks is the Fed needs to cut rates rather than hang tight. Ian Shepherdson of Pantheon Macroeconomics and Greg Daco of EY. Greg, I want to start with you. Both of you, Ian and Greg, are talking about how the balance of risks is we are seeing real weakness and this is just a tipping point that is going to deepen. What do these retail sales do to kind of edify that feeling of yours?
I think what they indicate is an environment where you're seeing a bit of a more caution, more prudence on the part of consumers. And this is not new. We've been seeing consumers be a little bit more careful, be a little bit more sensitive to higher prices. This cost fatigue that we've been talking about for a few months now is now starting to be visible in the data. We're seeing a little bit more caution when it comes to outlays. When you adjust outlays for prices, you're actually seeing a contraction in retail sales on a year-over-year basis. Service sector spending is still relatively strong, but we are seeing more caution. And the key reason for that additional caution is the fact that you're seeing some softening in the labor market. Not a retrenching, nothing alarming, but a bit more caution in the labor market as well.
What's the gap in between a bit more caution and true weakening, given that this is 2 straight months and pretty negative downward revisions as well?
Yeah, the downward revision is disconcerting because it sounds to me like the control group now is essentially flat over the last couple of months. And had been weakening before that as well in terms of the growth rate. So this is beginning to start to look like an entrenched softening. I mean, not a rollover, you know, it's not a disaster by any means, but it's very different to what we saw last year. Remember the second half of last year, we're looking at constant upside surprises and the consumers charging along at 3% real through the whole second half of the year. We're not going to do anything like that in the first half of this year. And I think a part of the reason here is as well as the labour market weakening, which is definitely real. You can see in the surveys that people are getting nervous about job security for the first time in this cycle, but they've also got less cash flow. You know, real income growth after tax is a lot lower than it was this time last year. Payroll growth is lower, wage growth is lower. There's just less cash around. And so people are just being a little bit more cautious at the margin. If you're a bit more cautious at the margin for a few months, it starts to build into something real.
And what it really speaks to me is if we have this price fatigue, is do corporates have pricing power anymore? We have seen some of those margins start to thin. So if we're in a world where corporates are having thinning margins, you don't have that labor constraint that you once did. Is this, as Jan Hatzius over at Goldman Sachs says, an inflection point for the labor market?
It's an inflection point for the labor market for sure, but it's also an inflection point for the inflation story as well. Because that margin expansion that we saw during the pandemic and in the year afterwards was a huge driver of the increase in inflation. And most businesses have held on to those margins, but if they're starting to crumble now, so we're actually seeing them come down rather than just hang around the highs, if we start to see them come down, it really does change the inflation picture because it was a really big part of the inflation story that's not kind of widely appreciated, but it's why I think core inflation next year goes below the Fed's target because of margin compression, and it's just beginning to creep in.
Greg, what do you think about that? Is this an inflection point?
I tend to believe so as well for inflation in particular, because we have seen more pricing sensitivity on the part of consumers. We're also seeing markups fall. We're in deflation territory when you look at some of the PPI indices for consumer pass-through. And we are still seeing some disinflationary currents in terms of the rent inflation side, and wage growth is also moderating. Put all that together, and all of the fundamental indicators in terms of inflation are pointing towards further disinflation. So if you have a forward-looking perspective, that is the right type of mix that you want to see from a Fed perspective in terms of easing monetary policy, not to bring rates down to zero, but to recalibrate monetary policy to today's reality.
So does December make sense in that scenario?
I think September makes sense. I would have actually thought that July made a lot of sense, even potentially June. You're not talking about cutting rates down to zero to stimulate the economy and prevent a recession. You're talking about how do you recalibrate monetary policy for an environment where inflation, PC inflation, core PC inflation, is within striking distance of the 2% target, likely to be around 2.6% in May. That is a point at which you want to start considering recalibrating monetary policy to have the optimal framework in an economy, as Ian was saying, where the labor market is gradually cooling, where wage growth and payroll growth are cooling, and where inflation is moving in the right direction.
We do hear from the New York Fed President Williams also speaking right now, actually. He's talking about that they're going to be data dependent. Well, if they are data dependent and this is the data, do you think they need to take another look at their dots and the timeline?
Absolutely. Greg and I are going to have an agreement fest here. but I honestly, I wish they'd cut rates last week. And they didn't, so I wish I'd cut them in July, but they probably won't. What worries me here is that they're very backward-looking, and they're constantly talking about what the data have been doing. And there's not enough discussion from the Fed about where the leading indicators, of which the US has an abundance. I mean, we have dozens of reliable indicators of the labor market, consumers, everything. And they seem to be resolutely ignoring them in favor of looking at the backward-looking stuff. And if you carry on doing that, then by definition, you're going to be late when you start cutting rates. And the danger then is that you end up with the economy slowing more than it needs to for longer than it needs to. So I think a bit of courage here maybe, and to say, okay, we don't have to wait until we're 100% certain inflation is going to get to the target, but to be reasonably sure now, I think is a pretty solid case. You know, the core PCE over the next few months, you know, is going to be 2 something, and it's not a million miles away, and yet rates are still at the highs.
If you are just joining us, we did get retail sales about 9 minutes ago, and you can see they came in across the board lower than expected, with downward revisions across the board as well to the prior month. You could see the headline coming at 0.1% versus the expected 0.3%, and a decline in the prior month of 0.2%. Looking under the hood at exactly what was driving this is actually interesting, and it speaks to some of the home builder story that we were talking about earlier. Furniture and home purchases were down 1.1% on the month. You can see building materials down 0.8% on the month. You could see this pretty much across the board. What are the parts that bolstered this retail report? Vehicles and parts, 0.8% gain. Auto dealers, 0.8% gain. You could see gas prices going down. That's gas station, 2.2% decline. But sporting and book costs, 2.8%. Glad to see that people are buying books. To me, this sort of raises this question, Greg, about how much the suppressed housing market, some people might argue the broken housing market, is suppressing retail sales in a way that's distorting the data and frankly could rebound really substantially. If rates come down, people buy homes again, they find it accessible. Is this sort of muddied data that's being skewed by otherwise kind of broken housing markets?
So the housing market's certainly frozen, but I'm not sure you're going to see a massive reacceleration in the housing market unless you see one of 2 things, or one of 3 things. 1, prices falling quite dramatically. 2, interest rates falling quite dramatically. Or 3, income growth accelerating quite dramatically. As Ian was pointing out, we have real disposable income growth that's currently at 1%. That's a really low number. You have home prices that are still high and still coming up higher and higher given the lack of supply. And you have interest rates that are unlikely to fall back quite massively given that the Fed is likely to maintain this higher for longer monetary policy stance. So I don't see that as a potential for a comeback. And if you look at the underlying drivers of consumer spending here, you have income growth that is still moderate, you have a low savings rate, and you have wealth growth that is not accelerating as much at the same time as credit is tight. So you have this bifurcated outlook for consumers where the lower end, younger generations, more indebted consumers are struggling to make ends meet in this environment.
Ian, to the point of bifurcation, I wonder if we look at this data, if again, maybe it doesn't accurately capture things if there's this housing confusion, but also the bifurcation. If you're looking at the richest people who essentially just buy assets, they buy assets, they're investing in the stock market. Does something like this give us the full picture? Or is it really just capturing what we know has already been under pressure?
Yeah, I mean, the lower end of the income distribution is now under stress in a way that they haven't been since way before COVID. I mean, the fiscal stimulus, the checks in the mail that we got through the pandemic was a huge support to consumer spending, and especially for that middle and lower part of the income distribution. You're right, at the top end of the distribution, you know, cash flow is not really important. It's all about asset prices. But the variations in consumer spending are driven by the actions of the middle and lower. And so if those people are now seeing much slower income growth than they saw last year, and they're beginning to worry a bit about job security, you know, the New York Fed survey asks people, do you think unemployment's going to go up? Are you worrying about job security? And those measures have both gone materially higher. So that's not a great combination. You know, that's a combination that tends to make people save more because of worry, but they're saving more from smaller cash flow, which means spending gets hit harder. So this is, you know, again, we're not at the point where everything's falling apart. That's not the story here, but I think we've got to get out of the mindset that, you know, it's just been constant upside surprises from the consumer. Well, not anymore.
When you look at the bifurcation, and I know you pay attention to the surveys, do you see a real hollowing out of the middle class?
I think that's probably going a little bit too far. You know, we've seen very strong job growth, and the unemployment rate's been very low. And you know, nothing is better for, you know, for the middle of the income distribution than seeing sustained low unemployment. And wage growth, although it's slowing, is still pretty good. You know, we had a long period after the crash in 2008 where wage growth was less than 3%, and we're way above that now. But you know, the price level shock from the pandemic has scared people and made them nervous and unhappy, and that's one of the reasons why the administration's poll ratings are are so low. But actually, real wage growth is, at the moment, is still positive. But it's probably going to get weaker. And as it gets weaker, it just makes people more cautious.
Greg, when you look at these kind of retail sales, do you then expect potentially more companies to come out and have to say, I guess we need to start slashing more prices to make sure we can keep some of that market share?
I think you're already seeing it. You're already seeing a lot of companies think about incentives as a way to drive consumers to spend more. And as Ian was pointing out, if you look at the different income quintiles, you're seeing the bottom and median income quintiles being much more price sensitive. What does that mean? It means that they have to get greater focus on how to drive consumers to spend. But you have to do that at an affordable price. And in order to do that, you're probably going to need some incentives. What that means for the overall economy is slower consumer spending and ongoing disinflation, because those price cuts in certain sectors are going to lead to further disinflation. This is actually a positive story. It's a positive story where the Fed has to be careful to recalibrate monetary policy and adjust to that environment and not be so backward looking, because backward looking can be very dangerous in an environment where you have a lot of noise in the data and downward revisions a month later that show a different picture when it comes to retail sales.
Well, and to your point about this isn't necessarily a negative story, this has been one of the key questions for equity markets. Is bad news good news at a time where disinflation can potentially be positive? You could see it this morning, toggling around how to interpret this, basically lower at the moment futures on the S&P, although they were higher. You could see yields markedly lower across the board. This from Drew Mattis over at MetLife, and I think it really crystallizes the fear that a lot of people have. He said it may seem to have been the break month. Lower sentiment, lower retail, higher claims. The question is whether this is going to spiral downward, and if so, when does the Fed recognize it? Ian, given that view that some people have, and I believe you are sympathetic to it, what is the chance of a Fed error at a time where the Fed is looking for December for a Fed rate cut?
Oh, the chance of a mistake is going up, for sure. Monetary policy works with very, very long lags. I can't stress enough how long it takes for the economy to respond to whatever the Fed does. The economy is now clearly softening, but it's 2 years since they started raising rates, 2 years. And that means that if they start cutting rates tomorrow, it will be well into 25 or even 26 before we start to see the upswing triggered by that easing. And so between now and then, potentially, we could be in for quite a long period of sluggish growth. I'm not, at this point, not terrified of a downward spiral disaster because the private sector's finances are in much better shape than you normally have at the start of a recession. But I can see the risk that the Fed presides over quite a long period of sluggish growth, which is probably unnecessary to get inflation out of the system, which is why I think sometime next year they'll end up with inflation below the target and monetary policy getting much easier. So the equity market is kind of toggling between this bad news is good news because lower rates and also bad news is bad news because low margins. So there's going to be a real kind of push and pull in stocks, I think, over the next few months where, the rate people are just buy because valuations and the margin guys are saying, well, hang on a minute, this is a loss of volumes and margin compression at the same time. So it could get a bit sticky.
Greg, final word?
I'll disagree a little bit with Ian for the first time.
All right.
But I think there is a risk that the economy actually worsens more because of the self-reflective interdependence between the Fed and financial markets. You have this unhealthy environment where the financial markets are trying to price what the Fed's going to do based on data, which is backward-looking, and you have the Fed that's essentially looking at financial conditions to try to evaluate how tight its monetary policy is. If you end up in an environment where there's a sudden pivot at the Fed because of disappointing economic data that's backward-looking, that could catalyze into something that's more pronounced in terms of financial markets, seeing this as very bad news and thinking that the Fed is seeing a recession down the road, and you could have this negative feedback loop that weighs on the economy. That's a potential downside risk via the financial markets channel.
The game theory of what we see with the markets and the Federal Reserve. Greg, Ian, both of you, thank you so much for being with us. Ian Shepherdson of Pantheon and Greg Daco of EY. Up next, setting you up for the day ahead, plus David Rubenstein of the Carlyle Group joining us with the latest on peer-to-peer conversations. This is Bloomberg. Down to the opening bell. David Rubenstein in the office with an Orioles tie, which has ignited a heated debate
They're
around
playing the Yankees
table
tonight, 7 o'clock.
Here is the trading diary for the week ahead, not the Yankees game. Today is loaded with Fed speak, including Barkin, Collins, Logan, Kugler, Musalem, and Goolsby. Wednesday, markets are closed for Juneteenth. Thursday, the Bank of England decides, plus another round of jobless claims in the United States. And Friday, S&P Global PMI data. Joining us around the table after we did get retail sales is David Rubenstein wearing his Orioles tie, even though you can't see the Orioles, of the Carlyle Group, as well as, of course, a host of Bloomberg Wealth. And David, the interesting aspect of your interview this week is it's with someone who runs a $2.7 trillion wealth management firm at a time where we have talked extensively this whole morning about the uncertainty around how to position portfolios. Retail sales could be signifying some sort of rolling over the consumer or just a welcome softening. How did your guest sort of reshape the way he's viewing asset allocation and strategy at such an uncertain time?
Okay, so the person is Mike Gitlin, and Mike is the CEO of Capital Group, which manages $2.7 trillion, one of the largest money managers in the world. And their view is that the conventional wisdom, which is you can't beat the markets, is wrong. And therefore, they basically actively manage stocks and bonds, but mostly stocks. And they beat the market pretty consistently. So you don't know about them as well as maybe you should because they work through RIAs, registered investment advisors. And so they generally, if you go to your money manager and say, give me a good mix of stocks and bonds, they probably will contract with Capital Group to actually do a lot of the stock investing. So it's not as well known publicly as, let's say, BlackRock might be. But it's an incredible company. It's been around for quite a while. I was started in the 1930s. And they basically have the view that they can beat the market pretty consistently, and they have. And he is a bond person by background. And so when he came in, it was a different kind of mix than he had been expecting to do because the firm he had been with before was also a stock equity firm. But at T. Rowe Price, he also built up their debt business. And now he went to Capital Group, built up their debt business. And nobody would have thought a debt person would have become the CEO. But he's so smart and he's so good that he basically became the CEO last year. And it's a firm that's privately owned, will never be public, I assume. And so it's not as well known. But it's a really good firm.
It's a fascinating and maybe challenging time to be an active equity manager because you could say, look, I can buy a cheap passive fund and it gives me that exposure to the mega caps because it's market weighted, and that's all that's doing well right now. So what does it mean to be an active equity manager when you can stock pick, but you essentially got to pick 3 stocks? You got to pick NVIDIA, maybe Tesla now, and then you can outperform. But it's really challenging, that wider breadth to find the winners.
The conventional wisdom in the business schools and the academic world is you can't beat the markets. But some people who generally say that do beat the markets. So Warren Buffett has beat the markets fairly consistently. And so if you have a very good money manager and you are willing to stay with them for the long term, don't go in and out, you maybe can beat the markets sometimes. At least that's what the clients feel for Capital Group. You know, they have $2.7 trillion, so somebody must think they're doing a pretty good job. But they do it by a different technique. They don't pick one manager and say, here, you go do what you want to do, pick good stocks and so forth. They have a team of people, and the team together works on your account, for example. So it wouldn't be one person just managing your money. It doesn't sound like you're a Capital Group user.
I can't say I am, David.
Okay.
David, how is he positioning ahead of the U.S. election?
For any money manager?
And the individual you said now.
Here's what I say about it. Look, over the last 75 years, when a president of the United States is a Democrat, the S&P 500 goes up on average in that 75 years, 6.6%. When a Republican's president over 75 years, it's gone up 6.4%. So no real difference. So if you want to play the markets in and out and jump up and down in the markets and try to take that risk, yes, you can try to figure out what the president's going to do, what the market's going to do. But over a longer period of time, the markets will probably do reasonably well under Democratic or Republican presidents. And so I think really smart money managers are not worried about what's going to happen in November, December, January, but over the longer term. So I think many people, like the Capital Group people, would say, we don't really respond to elections as much as you might think we should, because over the longer period of time, the economy is so big that no one president's going to make that much of a difference.
David Rubenstein, how many Orioles ties do you have?
This is the only one I actually have. I keep wearing it, but I'll buy another one soon.
It's a good not looking to shame you for Orioles ties.
We're playing the Yankees tonight, and both of us have the Yankees and the Orioles have the best records in the American League. So we'll see what happens after a 3-game series.
All right. Are you going to head to Baltimore?
I will be at the game tonight.
David Rubenstein of the Carlyle Group. No, you're going to see AMH there saying, I'm all, pinstripes
I would
over
have
here.
worn my Yankees gear if I knew you were going to show up like this. So.
The Yankees are a nice team, but I think we.
Nice team.
But if you ever want to come to the Orioles game, let me know. Okay.
You can watch David's interview, not of Emery on Yankees, but Michael Gitlin of the Capital Group. Don't miss that at Bloomberg TV at 9 p.m. Eastern tonight, especially given his focus on debt markets, which actually makes him even more qualified for this moment, I would argue, in completely a biased way. Tomorrow, U.S. markets are closed for Juneteenth. Coming up on Thursday, Jonathan Stubbs of Berenberg, Evan Brown of UBS, Anastasia Amoroso of iCapital, and Morgan Stanley's Seth Carpenter. Right now, markets are trying to figure out how to digest a retail sales print that came in below expectations with downward revisions. We'll keep talking about that. Right now, it's a negative read. This is Bloomberg.